the unemployment rate moves up again, if you get a significant rise there, I think that's going to be a pretty worrying signal.
We're looking for north of 200K. Very importantly, a decline in the unemployment rate.
If we see a number closer to 100,000 this month, then we'll have to reassess our sort of view on the labor market.
It would take, we think, a pretty significant downside surprise to drive markets much lower.
There's no magic number here. It really is about the direction. And we should expect to see more softening in the labor market.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning. For our audience worldwide, Bloomberg Surveillance starts right now on a 3-day slide on the S&P 500, set to become day 4. For now, at least. Equity futures negative by 0.6% on the S&P, down by 1 full percentage point on the Nasdaq 100, going into the most important jobs report since the last one and probably until the next one. The estimates, the guesses, look a little something like this. The median in our survey, 165,000. Looking for the unemployment rate to drop back from 4.3 to 4.2. It is not if they cut interest rates this month. Bramo, it's by how much?
And this ultimately will be the deciding factor between 25 or 50, which is why I would argue, actually, this is an even more important payrolls report than just simply since the last time and until the next time. It will basically confirm the weakness that we saw in the July jobs print, or it will reject it and say it was seasonal, it was weather related. My question is, how asymmetrically are markets positioned to a downside surprise? And how much can you see some sort of bounce in yields if you do get the kind of upside 200,000 response that we're expecting from the likes of Bank of America?
There is a really strong bias right now to buy this bond market. We've had a 20 basis point move on a 2-year and a 10-year on the week so far. We're down another 3 this morning on 2s, on 10s, down a similar amount. This from SocGen. It's difficult to fade this move. Here's the line from them. Bonds are more likely to overreact to economic weakness than vice versa. I think that speaks to the bias of the moment.
Which is the reason why even the ADP report yesterday suddenly got more potential attention. If you take a look at the flows, and Bank of America puts this out along with EPFR data, it shows that in general, it is bonds that are getting the inflows, and it is stocks that are seeing some of their first outflows in the United States going back a couple of months since June. So this really is the bias right now at a time when people are reassessing a neutral rate somewhere below 3% for the first time that I've heard that in years.
Just to pick up on things in that FX note from Bank of America, here comes 50 basis points. That's what foreign exchange is screaming right now. Dollar yen down for a 4th consecutive session, 4 days of yen strength, 4 days of dollar weakness. This market, according to BofA, the FX market screaming, here comes 50.
Yes, Jonathan, FX market screaming, here comes 50. You started the show, though, with the exact point. It doesn't matter what we get. We know the Fed is cutting. The debate is 25 or 50. Yesterday, though, Austin Goolsbee overnight. The long arc shows inflation coming down. They're seeing this weakness in the labor market. But he said it's not just about this point. It's not just about potential this cut. It's the path. So after we get this cut in September, what does it look like for the rest of the year?
The conversation we're having around the table with market participants about what happens and what may not happen on September 18th still sounds very different to what we hear from Fed officials. We're talking about the difference between 25 and 50, and even some of the most dovish members of the FOMC aren't talking about 50. They're talking about perhaps a string of rate reductions over the next year.
Yeah, they're just basically avoiding it. Let's be clear. I mean, even Mary Daly, when asked specifically, is it 25 or 50, said, we'll have to see what the data says. None of them want to commit. They want to point to the destination, which raises the question of the destination, which no one knows anything about because we don't know what the neutral rate is. And ultimately, that's what I thought was most interesting about Austin Goolsbee. It is this sense that we have a long way to go. Then you hear from John Paulson, 2.5%. You hear from others, maybe it's closer to 3%. But nonetheless, suddenly we are talking about a neutral rate that A, no one knows anything about, that B, at one point was thought maybe is this what we're seeing right now, and C, is suddenly seen as something even closer to zero, as we heard from Ed Al-Husseini talking about where the destination could be. That is where we need to focus. That is where we're getting no clarity from Fed officials. And that is what I'm guessing Chris Waller will not address today at 11 a.m.
If you're exhausted by all of this, the good news is that the quiet period starts tomorrow, and then the Fed speakers can't speak anymore until the Fed decision on September 18th. Lisa mentioned the Fed speak. Let's go through the times. 8:45 Eastern Time. The New York Fed President, John Williams, is giving keynote remarks. We'll see if anything out of that actually speaks to the jobs number we had 15 minutes before it. And Lisa mentioned Governor Waller, 11 a.m. Eastern Time. That's going to be a big one to watch. The last big Fed governor set to speak before the quiet period kicks in a little bit later tomorrow. So that's how we're set up for the day ahead, the morning ahead. This is the price action. If you are just joining us, welcome to the program. Equity futures pulling back, weaker on the S&P 500. Stocks are lower, bonds are being bought. We've seen that all week as we've kicked off September. Yields are lower by 3 basis points. The 10-year 3.6967. In foreign exchange, another day of yen strength. For the euro, at least, things a little calmer, unchanged. Euro dollar 111.11. Coming up this hour, we'll catch up with Pelosky of TPW with stocks falling ahead of the payrolls report. Tobin Marcus of Wolfe Research as Trump pledges to cut the corporate tax rate. And Sarah House of Wells Fargo on what it would take for the Fed to go 50 at the upcoming meeting. Let's begin then with our top story. Stocks falling ahead of the August payrolls report at 8:30 Eastern Time. Traders looking for evidence that the Fed has stuck the soft landing. Pelosky of TPW Advisory taking an optimistic view on the economy, writing, "We read the US jobs market as solid. The consumer is healthy and credit markets as open and robust." Jay is with us around the table. Jay, good morning to you, sir.
Good morning.
What are you looking for at 8:30?
You know what? It's interesting, right? Because everyone wants to zoom in. What's the number going to be, right? We want to do the opposite. We want to zoom out, right? Because it's a number and we're going to deal with it and it's going to be what it is. More importantly, we want to think about the bigger picture. And the bigger picture is the global economy is fine. The U.S. economy is fine. Credit markets are wide open. Issuance is huge. Real incomes are growing, not just in the U.S., but in Europe and in Asia as well. You have global liquidity on a very nice uptrend. The Fed is going to reinforce that. Whether it's 25 or 50 is less important than we are in a global rate cutting cycle that is probably going to be the most synchronized in the last 40 years. Global liquidity, supportive. The public-private partnership investment spending for AI, for climate, and for conflict is robust, open, and going to support the global economy for the next couple of years. And I think we're going to have political continuity in the United States. I think Vice President Harris is going to win. I think she's going to win in a landslide. I think the opportunity for a Democratic sweep is growing. And that supports, and I know there's some grins around the table. No one's showing it.
There's no grins here.
That's fine.
Didn't happen if it's not on camera, Jay.
That's fine. But what it does is it ensures policy continuity in the U.S., which has led the U.S. to be by far the best performing developed economy in the world since the pre-COVID period. All this sums up to be supportive for earnings, and earnings are the linchpin for stocks. And not just Q2 better than expected, but the 12-month forward earnings outlook continues to rise, and it rises in the U.S., it rises in Europe, and it rises in the Asia Pacific. And when you have that situation, then you want to be supportive. You want to be focused on the opportunity set, not looking for a big drop. Stocks are not going to drop in a big way when earnings expectations are going up. Full stop. So we want to stick to the process, and we want to focus on rotation, not recession.
Okay, I started smiling on the 8th reason to be bullish. Elisa's going to give you every
I only gave 4. I don't know. How did you, I guess I gave it very convincingly because it's out of my gate. Okay,
can we sit on capital allocation just a little bit longer?
Sure.
When you say rotation, what are you thinking of? The rest of the world, small caps, the cyclicals? What are you looking at?
That's the point, John. Look, August was the 4th month in a row where the S&P went out at an all-time monthly high. The 4th month in a row, right? August was also when 47% of equity markets, global equities, hit new 52-week highs, the best number in over 3 years. So yes, you had the RSP, the equal strength S&P ETF, hit a new all-time high. So you have the cyclicals breaking out. So I think the opportunity set continues to just be very robust. And the fact that we're able to be where we are in the equity market with tech taking a pretty big header, we're effectively passing off leadership from tech to the cyclical space, from large cap to small cap. And with the dollar, which you pointed out is a very important point, and we've been focused on this for a while, and it's been a long time in coming, we think the dollar is rolling over, and that's going to support non-U.S. equity outperformance.
The reason why I was smiling is because the market disagrees with you on several different points. There is a concern about weakness, and if you take a look particularly at the commodity markets, you see oil prices at the lowest level in more than a year, and you have the OPEC plus countries really responding to this. How do you understand where you differ from the market and where the market could have sort of their hands around something that you want to pay attention to?
Well, Lisa, I've been around long enough to know when the market disagrees with me, that's not necessarily a bad thing. You know, if you can stick with the process, if you can zoom out rather than zoom in, That's where you want to be. And your point on commodities is absolutely right. That is the kind of the thing that's not quite working out from my view. And it worries me because we're long commodities. We're overweight commodities and underweight bonds. And we have been that way all year. And for the last month or two, that hasn't really been a great place to be because bonds have had a rally and commodities have not done very well. But when we go back to the zoom out and we go back to the global economy, which we think looks robust, we think we're early cycle, not late. We think inflation is behaving better than expected. The rate cut cycle is going to be supportive for the economies. That commodities probably don't have a lot of downside here. And the upside, we think, is relatively significant. And so, we're long oil, we're long copper, we're long a couple of other things as well, gold miners, uranium miners. And right now, they're all sitting on pretty powerful support levels. And they've come in a lot. So copper's down 20%, uranium's down more than that, oil is down significantly, as you said. So it's kind of it's a little bit, that's where, and the picture is never perfect, right? The picture is never perfect. And so you always have a fly in the ointment. And right now, for our point of view, the fly in the ointment, you identified correctly, it's commodities, and we're watching it very carefully.
In 2 hours and 20 minutes, we get what some people expect to be another fly in the ointment, which is a payrolls report that could potentially confirm the weakness that we saw in the July payrolls report. What would we have to see? What would we have to get for you to reassess the bigger picture view and wonder whether maybe some things were fraying just a bit more around the edges?
Yeah, as I said, we want to zoom out, not in. We try not to pay too much attention to any one number. It's a bigger mosaic than that. You have one little tile over here that's not perfectly set. That's going to be a little bit of a bummer, but you can fix that. When we look at the jobs market, the thing that we hang our hat on is that right now the percentage of job openings to people looking for work is roughly 1 to 1. People talk about it being like the lowest it's been in years. The other side of that coin is that it's better than it was for the entire period from 2000 to 2018. So the job market is just simply normalizing. It's not falling off a cliff. And when companies can issue bonds, as they have this week, right? This week has been a monster week for investment grade issuance. When rates are coming down, when credit is becoming more available, not less, we're not really concerned that the economy is all of a sudden going to fall off a cliff and people are going to have to lay off tons of workers. It just doesn't, we really don't see an environment where the economy is going to fall off the cliff. People talk about the consumer. Disposable income to interest obligations is at the best it's been in 40 years. There's no real pressure on the consumer. The consumer is fine. People talk about it like it's a problem. It's not a problem. It's fine. And companies are flush. And the government, which is really who's holding the bag these days in terms of fiscal expansion and big deficits, they are issuing plenty of debt, and everybody's happy to take it to the point we've been talking about.
Jay, let's talk about the government. I was one of those grinning because we're clearly looking at
everybody was grinning. I was happy to see that.
But you have such conviction about the election, even though it is, if you look at all the polls and crosstabs, it is a knife's edge. And Pennsylvania right now is what Josh Shapiro told me, a statistical tie. But given that said, if it's not a landslide, how do you see that, what you call public-private partnership? How does that change under a Trump administration?
Well, I think it's pretty clear, right? It's not just our point of view at TPW Advisory. It's the view of Goldman Sachs. It's the view of Moody's. It's the view of the Peterson Institute. It's the view of basically anyone who's looked at the two policy mixes of the two camps.
I thought we wanted to go against the establishment here, Jay. Then you just started listing a lot of establishment organisations very quickly.
Well, when it works for you, you take it. I mean, come on, John. Yeah, exactly. We go back to the big picture. But look,
Goldman Sachs agrees with me.
Yeah. I mean, hey, I'm a Morgan Stanley guy. And I don't, typically I'm not really all that excited about Goldman agreeing with me. But, in this case, since I'm under assault here from all sides, I'm pulling out every stop. But look, again, the U.S. has been by far the best performing developed economy coming out of COVID. Best growth, best inflation. That's the Biden-Harris policy mix. The sustainability of that, I think, is really critical to being positive about the U.S. over the next 4 years, right? We've had a view, global macro blue sky outlook, 2023 to 2027. That's our focus. Policy continuity in the U.S. is pretty important to that. The Trump agenda is an agenda where you're going to deport millions of people. What does that do? That just throws the job market into utter chaos. You're going to extend tax cuts. You're going to blow out the deficit. What does that do? That's really great for the dollar. You're going to institute massive tariffs on pretty much everything. What's that going to do? That's going to spike inflation. So as I look at it, you're talking about an imploding job market. You're talking about spiking inflation. You're talking about a blowout deficit. You're talking about tanking the dollar. So to me, I am a dollar bear. So I kind of like the Trump policy mix from that perspective because it is anti-dollar for sure. But on the other hand, we'll trade off that dollar smash for policy continuity because I think the dollar is rolling over anyway as the interest rate differential shrinks.
Jay, got to leave it there. It's good to see you.
Very much happy to be here.
I know it felt like 3 against 1, but that's not what it was. Jay Pelosky of TPW. Jay, thank you, sir. Yeah. Let's get you an update on stories elsewhere this morning, looking ahead to payrolls with some news and your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. 7 & I says it is informing Couche-Tard that the Canadian company's buyout offer is insufficient. The Japanese operator of 7-Eleven stores revealed for the first time the offer price, $14.86 a share, or that's a market value of almost $39 billion. It's a 21% premium to when the proposal was first disclosed, but it is below February's one-year peak in share prices. PwC has resigned as auditor for Country Garden. The defaulted Chinese developer says PwC is unable to fulfill the timetable requirements to publish its overdue financial statements for 2023. A filing shows it will be replaced by Hong Kong-based Zhonghui Anda. A source told Bloomberg last month that PwC was facing a 6-month ban, part of a punishment over its role in auditing another failed developer, China Evergrande. Broadcom shares lower in the pre-market trade, 8.7%. It disappointed on its sales forecast, highlighting non-AI operations that are growing more slowly than anticipated. The company does have a wide variety of offerings, including mainframe products, security and data center software. It's also among the main chip suppliers for Apple and other big tech companies. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes' time. Up next on the program, competing tax policies.
To further support the revival of American manufacturing, my plan calls for a reduction in the corporate tax rate from 21% to 15% solely for companies that make their product in America.
We'll talk about how workable that plan actually is on this Payrolls Friday this morning. Good morning.
It's Jobs Day, and Bloomberg has the report under surveillance.
It's from super hot to solid.
This is normal.
I think people underestimate the behavioral aspects when it comes to the labor market.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
So what is bad on September 6th?
Nobody really has a full answer on it.
I don't know what counts as good news these days.
It's a big debate.
The August Jobs Report, today on Bloomberg.
It is Jobs Day and your equity market is sliding. We're down by 0.6% on the S&P 500, just a little bit softer on the session going into that jobs number. Under surveillance this morning, competing tax policies.
To further support the revival of American manufacturing, my plan calls for expanded R&D tax credits, 100% bonus depreciation, expensing for new manufacturing investments, and a reduction in the corporate tax rate from 21% to 15% solely for companies that make their product in America.
So here's the latest. Donald Trump pledging to slash the corporate tax rate in an effort to fuel the U.S. economy. His plans directly contradicting the proposal from Vice President Kamala Harris that would raise rates to 28%. Tobin of Wolfe Research writing the following: only in the unlikely event of a Democratic trifecta do we expect market-wide earnings headwinds from corporate rate hikes, along with modest new tax benefits for families and housing. Tobin joins us now for more. Tobin, I just want to park the compare and contrast. I just want to focus on that conditional corporate tax cut from Donald Trump. How workable might that be?
I think there are pretty serious questions about exactly how to draw those lines. Certainly, it is deeply unclear from the way that he characterized it yesterday exactly how it's supposed to work. I think tax experts around DC are a little bit unclear on exactly what's meant by this. And frankly, all of this stuff, of course, gets fed into the congressional meat grinder. If and when he wins the election and has a chance to try and get this done, then there will be a process of trying to flesh this out. And it's not totally obvious how much support there will be, or again, how much implementation possibility there is around sort of conditioning that corporate rate cut on U.S. manufacturing.
Tobin, what I hear from a lot of people is that this is the opening salvo that Trump is talking about before negotiation. Is it your expectation he's coming in very low and then potentially it'll level out somewhere in the 20% range?
Yeah, I think that both candidates are proposing more than they are ultimately going to be able to get done on taxes. And your colleagues at Bloomberg earlier this week tallied up everything that Trump and Vance have talked about from a tax and fiscal perspective and got a number north of $10 trillion. I think it's fairly clear that we're not going to get a $10 trillion tax package through Congress, even if there's a Republican trifecta. So there's definitely going to be a need for prioritization. And, frankly, they're starting $4 trillion in a hole based on the need to extend the expiring portions of Trump's 2017 tax package that expire at the end of next year. The cost of just getting that done is going to be pretty serious at a time that our overall fiscal situation, of course, does not look especially good. The deficit outlook looks quite grim from here to the horizon. So, I think there's a lot of these proposals that are being thrown out there, whether it's cutting the corporate rate to 15 or no tax on tips or sort of this Social Security tax carve out. Not all of this is going to end up being doable.
Right. It's a grab bag, or what I call the Oprah election, on both sides when it comes to these. And to your point, it really depends on Congress. But you also write in your note that for Harris, it's really about personnel changes, significant personnel turnover, and potentially she's going to be more pragmatic. Who exactly do you think she would put in positions that potentially move her more to the center?
Well, look, I think it's too early to speculate about exactly who it is that's going to get what job. But certainly the indications that we've gotten from the way that she's been running her campaign, from the way that the DNC was pitched, from the sort of reports from people around Harris, are that we're probably going to get fairly establishment figures. I mean, that's what the campaign looks like. She's, I think, notably not under a lot of pressure from the left. Compared to where Biden was in 2020, when he had done these Biden-Sanders unity commissions to try to heal the wounds coming out of that fairly bitterly fought primary. And so the Biden administration, in many ways, has been a power-sharing arrangement, with progressives almost as a junior coalition partner. And Harris is not in that position. That dynamic will change after the election. Certainly, I don't think that the left wing of the Democratic Party is going to remain quiet indefinitely. Certainly, they'll come out and want their seat at the table. But she's not, heading into this election having made a bunch of promises about who gets what or how much power the progressive wing gets. And so I do think that she will have the latitude to put people around her that she has confidence in. And I think that generally that's going to be people who, she's putting in there to make good decisions, to trade off costs and benefits rather than, set of ideological commitments driving it.
Tobin, just quickly here, we've heard a number of banks, including JPMorgan and Goldman Sachs, talk about Donald Trump's plan as leading to a steeper deficit over the next decade. Do we know enough information, given all the holes, to even say who's going to create a bigger deficit?
So I think there definitely are questions about it. And looking at the stated plan and what that means for the deficit, I do think is, at some level missing the point, because so much of what is being proposed is not actually going to get done. I think the risks of a high deficit are probably highest under Trump. There's more freedom of movement in a Trump win scenario because he is so much more likely to have unified control of Congress. But the bipartisan scenario under Harris, where she probably would be facing a Republican Senate, could very well be a high deficit scenario. She has proposed to extend most of the expiring tax cuts, as Biden did. If that happens, I think it's probably not going to be paid for in substantial part because it's going to be really, really challenging to get bipartisan agreement on $3 trillion worth of offsets to cover the cost of that. So, in a Harris scenario, we may well see just a large deficit finance partial tax extension, even if you don't get a lot of proactive new policymaking, no greenfield stuff.
Tobin, got to leave it there. Appreciate the update. Thank you, sir. Three-day slide on the S&P 500 through yesterday into this morning. The slide continues. We're negative by 0.6% on the S&P 500. On the Nasdaq 100, down by more than 1%. We'll talk about the drag from Broadcom in just a moment. The small caps, the Russell, negative by 0.45. In the bond market, let's chop up the yield curve, the 2-year, 10-year, 30-year, and focus on 2s and 10s. We've had a move this week of 20 basis points on both the 2-year and the 10-year. The 2-year down to 371, on the 10-year down to 369. I mentioned Ian Ligon of BMO a little bit earlier this morning. I was talking to Lisa about him a few times. This is the survey they do, pre-NFP. In that survey, they said investors are anticipating lower yields and there is a bias towards buying any post-payrolls down trade. 47% of respondents anticipate that the next 15 basis points in 10-year yields, Lisa, will be lower.
And that's what you saw from other firms as well, who said that right now their clients are buying bonds with no questions asked, that they're looking at the data second. And to me, the question is just how asymmetric is this sort of balance of risks? If you get some sort of downside surprise, buy bonds. If you get a massive upside surprise to the non-farm payrolls report, maybe sell around the margins, but then the buyers are going to swoop in because there is this belief this economy is materially slowing.
It feels like this is the trend, and it's going to take more than one jobs report to convince some people otherwise. Let's turn the page and get to a different story in foreign exchange. Dollar yen. Dollar yen at 142.90. We're negative by 0.4%. More yen strength. I mentioned this note as well from Bank of America. The FX market screaming the Fed is going 50.
And this, it's not just the Fed going 50. It's also this idea of the Japanese authorities that are expected to hike yet again later this year. At this point, though, a lot of people saying because of all the noise elsewhere, the biggest litmus test for what the currency read-through of the non-farm payrolls will be the yen. That's what people are looking at. Mark McCormick coming up is basically saying it's almost the highest conviction trade at this point because of both sides of the trade, whereas the other sides get a little bit more fuzzy in terms of the direction of travel for those central banks.
Good evening, Tokyo. 142.90 on dollar yen. Under surveillance this morning, some top stories for you. Here's Broadcom delivering a disappointing sales forecast. The company expecting sales to come in at roughly $14 billion in the fiscal fourth quarter, suggesting its non-AI operations are growing more slowly than anticipated. Lisa, that name is down by almost 9% in early trading.
Was it really that bad? That's what I'm wondering. If you take a look at the data, it wasn't terrible. What it did suggest is that non-AI types of applications saw a little bit of a decline. I'm more interested in what the read-through is to Apple, because that is their North American customer that they refer to obliquely on a lot of their calls. They're such a big supplier. Does this indicate a little bit more weakness in some of the smartphone development? That might be the more interesting angle here.
They also still beat expectations, and the market is reading into the part of Broadcom that's not really attached to AI. Morgan Stanley, after the report, saying AI growth is, quote, not linear, but remains strong. If everyone is in this bonanza about AI, and that's still the part of their business that's growing, it does feel like what you say. It wasn't that bad.
Big week for the smartphone business next week. Apple with a big unveil on Monday. Huawei with a big unveil on Tuesday. We'll have some guests for you on that to kick off next week. I want to talk about the Fed speak briefly. San Francisco Fed President Mary Daly telling the Wall Street Journal any further slowing in the labor market, quote, would be unwelcomed. Chicago Fed President Austin Goolsbee also speaking, telling Market Watch he's seen mounting warning signs from the labor market and expects, Lisa, multiple rate cuts over the next year.
And that's the key. This isn't just about 25 or 50. You were mentioning this before. This, to me, is really an interesting quote, and I want to read it verbatim. The long arc shows inflation is coming down very significantly, and the unemployment rate is rising faster than Fed officials had expected in June. There is a feeling that things are moving more quickly and that maybe, even though everyone says again and again, Fed officials do not see anything that we do not see, maybe they are seeing something that we do not see. And you could feel that in the tenor of the beige book and some of the motley picture behind some of these data points, as well as particularly from the Chicago region that Austin Goolsbee oversees.
Look out for Williams and look out for Waller a little bit later this morning following that jobs report at 8:30 Eastern time. Let's talk about the latest in the steel industry. The Cleveland Cliffs CEO, Lorenzo Goncalves, saying he would bid on U.S. Steel's assets if Nippon Steel's $14 billion takeover bid fell through, adding that he's working with JPMorgan and Wells Fargo on a plan. His comments coming a day after President Biden was said to be preparing to block the Nippon Steel deal. AMH, the saga continues.
Yeah, and it's welcoming for this CEO who's been one of the individuals at the table trying to bid for this. He says, I will not deploy the details of the package in this interview, but we are good to go, good for the money. 2 questions. What is the money? Because they came in under Nippon Steel's bid. And 2, if this was to go through, where's the FTC when it comes to then the steel industry in the United States? Because this would be a massive and really the only big player.
All I can say is I just don't have a lot of clarity on what actually is going on. There are questions around, I mean...
You're not alone.
I mean, the idea of questions about how they're sweetening the deal for the unions, the questions around the fact that Nippon Steel came out and said that they had not been informed that Biden was planning to block it, the idea that you have suddenly, Cleveland Cliffs coming in saying, hey, guys, here we are, we're still available for you. All these things, you don't get a sense of some sort of controlled process and how much of this is a negotiating tactic and how much of this is actually real.
It's certainly a big feature of the campaign trail, that's for sure, and will continue to be, I have no doubt. Let's turn to foreign exchange. Mark McCormick of TD Securities looking abroad to see how the US stacks up to the rest of the world, writing non-US growth is indeed slowing, led by an ongoing China slump. Global manufacturing PMIs continue to slide. Geopolitical risks are on the rise again, and the fall brings tons of event risk that should reinforce higher volatility and sluggish carry returns. Mark is back with us for more. Mark, welcome back to the programme. Let's go with this quote. I think it's really important. We've talked a lot on this programme about normalising interest rates here stateside. Haven't talked nearly enough about rebalancing growth differentials. How difficult would that be given the struggles that we see in Europe, the struggles we see in China?
Well, I think that's where all the asymmetry basically lies, because essentially what markets have been doing is been looking only at the U.S. data, U.S. surprises, U.S. growth revisions, and the Fed. And basically what they're saying is U.S. is slowing, the Fed's going to deliver some cuts, inflation's moving in the right direction. We don't really care about inflation more. All we care about is labor market and growth. And what they're kind of missing is that China, all the leading indicators we track are at a much lower level than the U.S. And the rate of change on where all those indicators are in Europe are actually moving further and faster in the wrong direction relative to the U.S. So when you stack it all up, a big piece you have to think about is, again, FX is a relative market, but it's only focused on one absolute theme, which is the U.S. So I do think that we're going to broaden the understanding out. It's like we're at September. We know the Fed's going to cut, whether it's 25 or 50. I don't know if it's going to have a tremendous impact in the months ahead, but what matters is what's happening outside the U.S., particularly as we get through the election and what those consequences are for some of these other countries.
So let's get to the trade. Mark, are you saying there's limits to the downturn in the US dollar, or are you saying that this can flip in the other direction? It's time to get long?
Well, we're absolutely, we're long the dollar. We have 3 views. We like euro lower, we like Kiwi lower, we also like Singapore dollar lower. So those are 3 ways of kind of thinking through it. I think, as you mentioned, you were talking about the asymmetries. I think it works this way. One, we're well above consensus. TD is basically at 205 today, so we're looking for a pretty strong rebound. I think the asymmetries is what we tend to do is, if you look at the factors that are driving the FX market based on the portfolios we run, this is all about mean reversion. There's really no macro story, inflation, growth. Those indicators aren't really driving performance in FX the way we think they are, at least based on narratives. And it's positioning and short-term valuations that are really dominating FX performance this year. And what we've finally seen is those indicators have flipped in favor of the dollar. So I think once you start seeing the market positioning and biases leaning in one way, if you get surprised, then you start to see the market move the other way very quickly. So I think that's the pain trade here, is that the dollar could rally quite aggressively on the number we're looking for versus, say, if data comes in weaker than expected. I don't know how much more downside there is. Obviously, the knee jerk will be important, but I don't think there's a lot of follow through.
Let's look at some of the assumptions that are underpinning the market positioning that you're talking about. We were talking earlier about just how much the Fed can cut rates, and the idea that the FX market is essentially pricing in a 50 basis point rate cut this month. There's also this belief that the Federal Reserve is likely to cut more aggressively than the ECB. This comes even as we saw wage inflation come in lower than expected today in the Euro region. Growth actually downgraded in the latest reading. At what point do you think that is poised to flip, with people looking for at least the same number of rate cuts at the ECB, if not more?
It's an important point. I think what's happening is the market's trying to figure out what the neutral rate is in the U.S. Fed's discussed it. There's a short-term rate. There's a longer-term rate. And if you look at market pricing on the Fed, essentially neutral rate has gone like very, very low. Just think of the assumptions around how do you get to a 3% terminal rate? 2% inflation, 1.5% growth. Those are basic assumptions that even if you have 2.5% and 1.5% growth, just in terms of inflation and growth, you're still somewhere 3 to 4% in terms of a neutral rate. So market basically taking Fed pricing 2 and below 3% is indicating that there's a recession. And it's not the same read that you're getting from the equity markets. So I do think that there's a massive disconnect that if the U.S. data, which again is starting to stabilize and moving in a better direction on the whole, and we're actually starting to see these indicators move in a worse direction in the Eurozone, I think that the line of direction here is that if things get worse in the U.S., they're likely to get worse in Europe. And I think if things are going to get worse in Europe, the thing that's really connected is China. China and European data are linked at the hip. So what you're starting to see, if China is a leading indicator, it's one that's telling you that things are not going to get better in Europe. They're likely to get worse. And if you think about what we have to see come from France is they will deliver a budget. We've also seen the German elections. I think there's also a feedback loop here where the politics can reinforce waning confidence in the European growth story. So to me, we're probably at peak divergence between the ECB and the Fed. And that, again, the asymmetries basically see that the rate differentials move in favor of the U.S. And also keep in mind that the relative equity story is I don't think Europe looks very attractive relative to the U.S. on equity performance.
I don't want to go into the neutral rate right now because I get very passionate, Mark. I really feel like this is the key question right now as everyone tries to game out exactly where that neutral rate is. You talked about peak divergence between the ECB and the United States, the Federal Reserve. Do you think that we're seeing peak divergence right now between the Federal Reserve and the Bank of Japan at a time where this basically is the consensus trade increasingly that the Bank of Japan is going to hike rates again and that potentially that could continue giving that strength that we're seeing in the yen?
I think it's amazing how quickly consensus can flip because the expectations is the BOJ was not going to be able to do anything this year. Again, we've been on the side that they have to move. We're looking for the July hike and we are looking for more hikes again. I think, again, a big piece of this is we kind of discussed is there's Japan Inc. It's, again, the government, the pension funds, and the BOJ are all working to strengthen the yen, reduce the undervaluations, and, again, trying to find a way to bring some of that money back home. There was a great Bloomberg article that went through the GPIF and the expectations of people who cover the GPIF and where the money's going. And essentially on the equity and on the fixed income side, they're bringing more money home. So, they continue to raise rates. That gives the GPIF an incentive to repatriate foreign invested bonds back home. And so that is further cushion to strengthen the yen. So I think the key themes, the highest conviction trades we have is we're going to get more macro volatility. That continues to undermine the carry trade. That's bullish for the yen. And the yen should continue to outperform G10 crosses. And if we get more volatility and the U.S. election is a big driver, again, I think the market's completely ignored what is basically a toss-up at this point. If you think about, again, Trump's platform of deregulation, tariffs, and tax cuts, that's good for U.S. equities. That's bad for rest of the world growth. That's more defensive positioning. So for us, it's higher vol, reduced carry, strong yen, and a defensive market that reinforces the dollar.
Mark, why hasn't the market priced in election risk?
I think there's a lot of fatigue around how to trade it. Everyone's wanted, right out of the year, there's a lot of interest in, what should we do? How do we hedge? Dollar CNH should be higher. I think it's just there's been so much uncertainty and it doesn't stick as a trading theme. And, people were able to sink their teeth into the U.S. story, the Fed story, the data story. Again, as we've talked about in our research, we use the term serial monogamist, at least for the FX market. It can only focus on one thing at a time. And then when it gets distracted, it finds a new theme and it kind of sticks with that until that doesn't work. So I think the U.S. election just hasn't had the sticking power because, again, there's no conviction. It's, again, even when it was very clear that Trump was going to beat Biden, at least based on the polling data, we started to see the emergence of trades that would resemble a Trump victory. U.S. MSCI outperforming China, some strength in the dollar. That all just went away. And I think we are now kind of back to having to focus on this. We've got the debate next week. And I think when we roll in through September and October, the market no longer can avoid this theme. And we'll be past the Fed. They will have potentially cut in September, and we can focus on a new thing. And that thing's going to be probably the French budget, the U.S. elections, and some of the lingering geopolitical risk. Because one of the things that's really important, what we've seen is our geopolitical risk index is now at a much higher level than what we see on our macro volatility index, which to me suggests that the markets there's some discontinuities there.
Stacked 2 months ahead. Mark, thank you, sir. Mark McCormick there of TD. If you are just joining us, welcome to the programme. Payroll's out a little bit later this morning, 8:30 Eastern Time. The estimate in our survey, 165,000 for the unemployment rate, looking for that to drop from 4.3 to 4.2. The number's just around the corner. Let's take the opportunity to get you up to speed on some stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Biden's son, Hunter Biden, is avoiding another trial. He pled guilty yesterday to federal tax charges after his gun case conviction just months ago. The tax charges carry up to 17 years behind bars, but federal sentencing guidelines should mean much less time. He will be sentenced in December. Apple has approved an update for Tencent's WeChat just in time for the iPhone 16 release. The latest version adds new features that include the Instagram-like WeChat moments and live streaming, that according to unnamed sources. There had been speculation in China that a dispute between Apple and Tencent over App Store fees would snowball into something larger, but this app approval helps put an end to that speculation. Super Typhoon Yagi came ashore Hainan Island in southern China with destructive winds and torrential rain. The Joint Typhoon Warning Center said Yagi had maximum sustained winds of 150 miles per hour. That storm is equivalent to a Category 4 hurricane, which is considered a major storm. The typhoon is expected to cross Hainan's west coast today. That's your Bloomberg Brief. John.
Danny, thank you. We'll touch base with Danny again in 30 minutes. Up next on the program, catalyst for a cut.
I don't necessarily think that we have to have a payroll report that is as strong potentially as 100K to have 50 basis points. I think the 50 basis point rate cut is really going to be dependent on an environment that is much weaker than what we're seeing right now.
I love the framing of that. 100K still strong. Greg Dacko. Just how low is the bar? That conversation up next. Stocks down once again. 3-day slide could become day 4 on the S&P 500, down by 0.6%. Yields lower by another 3 basis points on a 10-year, 369.48. Under surveillance this morning, catalyst for a cut.
I don't necessarily think that we have to have a payroll report that is as strong potentially as 100K to have 50 basis points. I think the 50 basis point rate cut is really going to be dependent on an environment that is much weaker than what we're seeing right now. The Fed does not want to be appearing as recalibrating monetary policy rapidly in an environment where the economy is still relatively strong.
So here's the latest. This is the setup. We're less than 2 hours away from critical jobs data. Bloomberg survey is expecting 165,000 jobs added for August, marking a stabilization in the labor market. Sarah House with Wells Fargo saying the employment situation for August will be imperative in determining if the rapid deterioration in employment conditions indicated by last month's report was merely noise or a signal that the jobs market is struggling to maintain traction. Sarah's with us for more. Sarah, welcome back. Let's go there. The distinction between the two. What are you looking for this morning that confirms it's one and not the other?
Yeah, so I think it's really a matter of momentum. So to what extent do we get perhaps a bounce back in hiring, which we in the consensus expect? To what extent do we get a possible dip back in the unemployment rate versus do you actually see the actually worsening? So seeing the unemployment rate increase and potentially a further downshift in the hiring numbers.
Sarah, looking at some of the guesses today, at the upper end, when I double click into the research and get the explanation for why people are looking for 200K, there's a buzzword on Wall Street this week. It's payback. I keep seeing this word payback and then I read the word weather. Sarah, what was it about July that might have been impacted by the weather and how much payback do you expect to see in this report?
Yeah, so I think there are some expectations that given you had Hurricane Beryl hit during the survey week, that was depressing payrolls, that maybe you saw some misclassification of workers who were not at work due to weather, misclassified as temporary layoffs, which is why you saw that increase in the unemployment rate. I'm not buying the weather story so much when you look at the industries that would stand to be most impacted by that landfall of the hurricane, like construction, manufacturing, so those with weekly pay periods. Those actually improved over the month. We didn't see a big impact in terms of the response rate. And when you look at some of the state data, yes, you saw a big drop back in Texas, but you also saw 22 other states see payrolls decline. So it looks more widespread than that. So we're not expecting that much payback. I think some of the pickup we're expecting just has to do more with just some of the volatility that's inherent in the payroll survey.
let's say you're correct, bang on the nose, and it's 145,000 that we get at 8:30 a.m. Eastern. How much are we really looking at something more like 85,000 when you downgrade it for the revisions that we can expect in, say, 6 months' time?
Yeah, so that's the tough part. So obviously we saw the big benchmark revisions since the last jobs report that suggests that those initial prints have been overstated. So we think this has a lot to do with the birth death model. So the fact that we're still seeing more jobs added to because of business formation, which we've seen in the more recent data has really gone back to its pre-COVID trend. So while we didn't learn anything explicitly about the extent to which payrolls might still be overstated since last March, that I think there is still some skepticism that whether it's some of the monthly revisions or some of these benchmark revisions, that the underlying trend in hiring isn't quite so strong as first meets the eye, which I think will make the unemployment rate even more important than it usually is, as there has been, I think, some skepticism over the veracity of the payroll numbers.
There's also this belief that maybe there's something going on that is more pernicious, and that we've seen this in history, that it never looks like a serious downturn until it's too obvious and too late to really get in the way. Where are there those signs this time around? Because we've talked to different retail executives, we talked to analysts who say things are softening, but they really look more like they're normalizing. Can you point to anything that contradicts that and edifies what the market is expecting?
Well, I think it's more, again, going back to just this momentum story. So when we look at just the level of various labor market indicators, they're not bad in and of themselves, but it's that shift in direction that I think is where concern creeps in for me. I think if I want to look at some of the more worrying signs, I'd look at the gross hiring rate. So yes, we saw an uptick here in the July numbers, but still some of the lowest levels we've seen since 2014, which means that if we do get any pickup in layoffs, you're going to see a sharp slowdown in net hiring. So the layoff numbers, I think, are still one of the brightest spots in the jobs market, but that lower hiring rate, the fact that you continue to see the trend lower in terms of business hiring plans, whether it's the job openings, the small business numbers, you have the PMI, the employment PMIs, whether it's the ISM or the regional Fed surveys, are some of the weakest we've seen since coming out of the recession. I think all of those are still telling us that we're in a very delicate position with the jobs market, where that normalization could quickly turn into outright deterioration.
Sarah, when you say you're focused on the unemployment rate, the jobless rate barely rounded up last month. It actually was 4.253%. How important to you are those three decimals?
Yeah, so we've seen actually it's the past couple months that it's barely rounded up. So we've been expecting some give back in the unemployment rate in previous reports, and yet it just keeps creeping higher. So I think we have to be careful in terms of even just looking at it out to two decimals and really going back to the trend. So even if we get a dip back here in August, you're still going to see the unemployment rate up 0.5 percentage point from where it was a year ago. So that would signal that maybe momentum isn't weakening quite as much as what the July report signaled, but this is a jobs market that is still softening. We are back to, I think, what is a more idealized state, but if you start to see further weakening, it gets really uncomfortable, and I think potentially sets off that negative feedback loop, that where you get that pullback in income and spending and therefore hiring.
Sarah, got to leave it there. Sarah House of Wells Fargo looking for 145 in the jobs number at 8:30 Eastern Time. You can really sense the anxiety, can't you, from a lot of people looking at this market this morning. I've heard it all week around the job story, just how finely balanced things are, that if we get a really soft print, it's a string of 50s. We said this yesterday, you get a really strong print, you have to unwind some of the move we've seen in the last few weeks.
There's this feeling that we're really at a tipping point, that at this point you could see a real dramatic deterioration, or you could see a firming up and then even a recovery from some of the slowdown that we've seen. And it seems like almost the Fed is going to make the difference, even though we don't understand the transmission function that they actually have. But you hear this in everybody's forecast just simply because we're throwing darts. And that's what it feels like.
I see a lot of daylight between what we're talking about in this programme and what I'm hearing from Fed officials. Still a lot of daylight going into September 18th. We'll see what we get from Governor Waller a little bit later this morning. Equity futures on the S&P 500 pulling back once again near session lows. We're down by 0.7%. The jobs report is just around the corner. The next hour looks like this. Priya Misra of JPMorgan, Michael Zezas of Morgan Stanley, Bloomberg's Josh Wingrove, and we'll catch up with Aditya Bhave of Bank of America. From New York City, this is Bloomberg.
any chance that we are below 120, below 100, that's where you start to see some material volatility.
I certainly think if you do get a very weak print, say 125 or less, the Fed will likely cut by 50 basis points.
I don't necessarily think that we have to have a payroll report that is as strong potentially as 100K to have 50 basis points.
Take a deep breath. Things aren't falling apart out there. And, a continued expansion is probably still the base case.
If we get that solid increase, they're on the way of achieving the result of a soft landing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Kicking off September, selling stocks and buying bonds, and that trend continues. Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now. Your equity market on a 3-day slide. It looks like this morning. It could become day 4. We're down by 0.6% on the S&P 500. On the NASDAQ, down by 1 full percentage point. Switch up the board and get to the bond market. The state of play, your scores. The 2-year, the 10-year, sliding for 4 consecutive sessions. This week alone, down 20 basis points at the front end and long end of the curve. The 2-year, 371. The 10-year, let's call it 370. Let's get to the guesses. The guesses look like this for 8:30 Eastern Time. 165,000 for payrolls, the median estimate in our survey. That's the headline. For unemployment, we're looking for that to drop back from 4.3 to 4.2, and immediately after, you'll see some revisions to some notes about whether we go 25 or 50 this month.
The time has come. That set off the trajectory, at least in the bond market. Stock market's just basically following the back-to-school trend of selling risk assets. But what we're seeing is the market pricing in rate cuts, and the question is just to where, given the fact that the Fed has already said the time has come. And that's where these estimates start to really make a difference. If they cut by 50 basis points, it's important to frame this. It doesn't just mean a one-time cut. It raises the point that maybe they will be cutting much more aggressively to an end point that is lower than what a lot of people thought.
That's why Austin Goolsby's comments last night were interesting. And then you have Stanley coming out from Santander saying he thinks it's pretty interesting that right after we get those numbers, we're going to hear from Waller and Williams. UBS's Paul Donovan this morning. In a well-run central bank, a single employment statistic would not change policy. Under Powell, data dependency mantra, the tone of this report could influence the size of the September rate cut. That's why it's going to be so important to hear what the Fed officials have to say after the data drop.
They say they're not data point dependent, yet this conversation sounds very data point dependent.
Well, part of that is because there's a question of how much it confirms what we saw from the July jobs number, right? This is the idea. Does it basically talk about payback, which you mentioned earlier, this idea that it's better than expected because it's taking into account the jobs that somehow were lost with weather-reported disruptions? Or is this really going to confirm some sort of downward trend that is faster than people previously thought? That's the reason why. Again, it's 50 basis points. And then what does that signal about where the Fed's headed?
Noise or signal. If you are just tuning in, welcome to the program. Cross-asset, equities down, bonds bid. The trend continues. Stocks lower by 0.6 on the S&P. Yields down by 3 basis points on a 10-year, 369.67. And the euro just about unchanged against the dollar at 111. Coming up this hour, we'll catch up with Priya Misra of JPMorgan on what she's calling a break-even payrolls print. Michael Zezas of Morgan Stanley as Donald Trump doubles down on tariffs. And Aditya Bhave of Bank of America expecting an upside surprise at 8:30 Eastern Time. We begin with our top story, counting you down to U.S. payrolls. Bloomberg survey expecting 165,000 jobs added for August. Priya Misra of JPMorgan drawing a line, writing, if we get a 150 or higher print, the market can disregard the weak July report as a one-off. But another weak print, less than 100,000, will suggest the non-linear weakening in the labour market is now upon us. Priya joins us for more. Priya, good morning.
Morning.
It's good to see you. I want to pick up on a line that you've been pushing now for the best part of a month. We've had some people come on the programme and say this market is pricing in things too aggressively at the Federal Reserve. You're going against that. Walk us through why.
So I think if I look at the total amount of rate cuts that are priced in, we're essentially, all we've done really is taken that endpoint from the end of 26, we've moved it to 25, which is a risk management approach. So I look at the totality of rate cuts. We're pricing that terminal rate after all the rate cuts at 2.9%. Whereas neutral rate, somewhere between 2.5 and 3, I would argue. So we're still pricing in very much a soft landing. I think what the market said is, well, the economy is actually slowing faster than it was 6 months ago. So the Fed, and we heard from Chair Powell, I think there was a subtle shift in the reaction function. They don't want any more cooling in the labor market. So that's the argument for a 50 now. Quickly get us to neutral. If the economy stays in a soft landing, that's essentially that 3% terminal close to that level. That's where we get to over the next year. I think the question is the economy still okay? Are we still in a soft landing? That's why I'm nervous about today. You get another print, a weak print. I'm trying not to be too stressed out before 8:30.
Sure.
But, I think then we have to worry that this is a fast, and we saw it in the beige book, we saw it elsewhere. They can cut 50, but what will that 50 do? Then they really should be cutting series of 50, get into accommodative territory. We're not priced for that.
So let's start thinking about the limits of this bond market rally. What I hear from you is that we don't need a recession or even much of a downturn to get 250 basis points of cuts. Is that fair?
It is, yes.
So you think there could be much more downside to yields from here than many people suppose, I guess?
I agree. I think if the economy is slowing down faster, and I'm not saying recession, I'm saying, 0 to 100,000 on payrolls, that's slowing enough that the unemployment rate's going to keep going up. The Fed's cutting to accommodative territory. And they can't cut 200 at one go. So the lags, when you incorporate lags, transmission, I think it could take them a year or at least 6 months to get to accommodative territory. By then, the weakening continues because of the lag effect. So where's the 10-year in a slowdown? 2%. 2.5%, because where's the Fed cutting to? So I still think about, we're so stressed out about September 25-50. Think about the total amount of cuts. 250 is consistent with soft landing. They're going to cut 300, 400. I don't know about 500. I think that needs a financial crisis. So I don't want to get people's hopes up too much in terms of total amount of cut. I hope we're not getting there. But why can't they cut to 2% in a recession or a slowdown?
Let's just build on that. You're actually speaking to a sentiment that we're seeing from Citigroup as well. And Citigroup's global head of interest rate strategy came out today in an interview with Bloomberg and said the Fed does not take baby steps. They showed no hesitation on the way up in 2022, and they won't show any on the way down either. If today's jobs numbers disappoint, expect a series of 50 basis points, not only in September, but also in November and December, too. Are you saying you agree with that you're sympathetic with that, and 150,000 is the line in the sand?
So I think initially I would completely agree. I think we're at 5.5. That's not the... Remember Chair Powell would say policy is in a good place. Policy is not in a good place. We're very restrictive. So can they cut a couple of 50s, 350s, as they're getting to neutral? Absolutely. Do they continue? Well, then we have to look at the economy. I don't know about getting to accommodative levels just yet. The economy seems to be in a soft landing. The totality of data, look at corporate fundamentals, default rate. It's not really suggesting that we're at the brink of a recession. We could get there. Recessions are always non-linear. I think this is what we're struggling with. Soft landing rate cuts are rare. It's happened once in 95. And so the market doesn't know what is a soft landing. And that was just 75 of total cuts. So I think, in my view, a few 50s, but this is where I hope they cut a few 50s to get us to neutral quickly. I don't know if they'll get there. Listen to the Fed speak. They're suggesting they have the luxury of time. At 8:30, we'll know whether they have the luxury of time. If things are slowing, they have to be fast.
You said something else. You said you don't want to get markets' hopes up that they're going to cut 500 basis points or whatever, that they're going to cut to zero again. And this raises the question of what the response will be to, say, a series of 50 basis point cuts in risk assets at a time when at one point you've got lower rates, meaning a good thing for risk assets, and the other, it speaks to something that's a little bit more protracted in terms of weakness in the market.
So I think the Fed will spin probably the first 50 or a couple of 50s as normalization. And so that's okay from a messaging standpoint, because the equity market's not going to say, what does the Fed know that we don't know? Why are they cutting 50? But this is where the data is going to come in. I'm more nervous about 8:30 in terms of, are we at the brink of the labor market deteriorating sharply? And if that continues, if, let's say, the economy continues to slow down, risk assets then are going to struggle. I think it's less about the 50, more about the economy where we are. Because, risk assets are perfectly priced for a soft landing. You increase that probability of a recession from 10% today to 25, 30%, that has to result in a repricing in risk assets. I don't know if 50 will do it, but if the data is weaker, I don't buy the argument that the Fed will cut 50 and so risk assets are okay. It takes a while. What's 150 going to do? Or even a couple of 50s, that's priced in. I think we have to get the economy stabilizing for some, maybe it's the election or some other global growth, which I'm not seeing really big signs of. We have to stay at this level for risk assets to take the 50 and say that's great news because we're normalizing faster away from this extremely restrictive policy.
Priya, how do you position in this world of nervousness you have?
I think high-quality spread products still make sense. I mean, you're locking in yields of 5.5%, 6%. And I think that's what explains why we're continuing to see flows into bond funds. You know, whether it's aggregate bond funds, corporate bond funds, you look at corporate fundamentals are strong. We are positioning more towards quality, away from some of the areas where we feel you're not getting paid up enough to take that risk. And I would say buy duration. I mean, this idea, I'd like to buy the 10-year above 4%. Well, we may not be getting above 4%. Any rise in rates here is a buying opportunity. Correlations are back. We haven't had any yield in fixed income or any hedging property for the last 20 years. It's there. You're getting the yield and you're getting that diversification benefit.
Let's say Jay Pelosky were sitting on the other side of the table and he'd say, just take the big picture, zoom out, things are great, U.S. exceptionalism. I don't understand why one data point is going to really tip the scales in terms of perception about whether the economy is falling off a cliff or not. Why would you disagree? Why do you think that this actually is the moment of truth where you're going to actually see the direction of travel?
I think the speed of the deterioration has increased. The economy has been slowing now for the last year. In the last few months, I feel like you saw the beige book, the last payroll report, and you get one more like that, you're going to get more nervous. It comes down to valuations. We should be pricing in a 30% chance of a recession. I'm not saying 50, I'm not saying above 50. Given the totality of data, there should be a probability. It's that as that probability goes up, valuations change. And then we can take a step back and say, actually fundamentals are strong, or the Fed has quickly normalized. See, we're debating economic data and the reaction function. Then you might be able to take a step back and say, valuations now are pricing in enough of a chance of a recession and I can buy. I don't think risk assets are there right now in terms of pricing in that risk that things may be non-linearly, which is not normally a word you hear on TV, but I'm glad I can say it here, that it's often a non-linear. Every recession is non-linear. I don't know if we're at that point, but I think today will give us more of a sense.
Priya, it's good to see you. Thanks for explaining your views. Priya Misra there of JPMorgan. The last time we had a jobs report that week, the 2-year was trading in the 440s, briefly, but in the 440s. We're down to the 370s this morning on a 2-year yield. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The head of global affairs for X is leaving the company formerly known as Twitter. Nick Pickles was one of the few senior execs who made the transition to X after Musk's takeover. He said in a post that he made the decision to leave months ago. The company, though, is losing its global affairs head at a precarious time. There's heightened scrutiny around the world and a Brazilian ban of X. X didn't immediately respond to a request for comment. Kamala Harris raised $361 million in August. That's almost 3 times more than Trump. She's raised $615 million since President Biden announced that he would step aside on July 21st. The campaign said in a statement that more than 60% of donors in August were women. 1/5 were either registered Republicans or independents. Nearly 3 million people donated, including 1.3 making their first donation in the 2024 election cycle. All of that according to the campaign. And in the U.S. Open, American Jessica Puglia shook off a rough set to storm back and take the match against her opponent in the semifinal. She moves on to her first ever major final, where she'll face off against Arina Sabalenka on Saturday for a chance at the trophy. In the men's tournament, 2 semifinal matches are ahead today, with number 1 ranked Jannik Sinner versus England's Jack Draper. And this evening, an all-American semifinal, Taylor Fritz takes on Frances Tiafoe. And that's your brief, John.
Very cool. Danny, thank you. Up next on the program, doubling down on tariffs.
The key to this effort will be a pro-American trade policy that uses tariffs to encourage production here and bring trillions and trillions of dollars back home. And you know what? We deserve it.
That conversation up next. Live from New York this morning. Good morning. The jobs report just around the corner. The scores look like this. Equities a little softer, down negative, off by 0.6%. The rally in the bond market continues in the 360s on a 10-year. We're down about 3 basis points this morning. Under surveillance this morning, doubling down on tariffs.
I intend to reverse this model and once again turn America into the manufacturing superpower of the world. We can do that just with being intelligent The key to this effort will be a pro-American trade policy that uses tariffs to encourage production here and bring trillions and trillions of dollars back home. And you know what? We deserve it.
So here's the latest. Donald Trump promising to use tariffs as an economic weapon in a potential second term. His remarks coming ahead of Tuesday's debate with Vice President Kamala Harris. Michael Zezas of Morgan Stanley writes in the following. Tariffs could pressure economic growth, but possibly more so outside the US, potentially driving more dovish central bank policies overseas than at the Federal Reserve. Michael joins us for more. Michael, good morning.
Hey, good morning.
That's a thoughtful take on the situation for global central banks. Do you think some of those policies could be more damaging to countries abroad than maybe domestically?
Yeah, well, listen, if you think about the U.S.'s posture in terms of its trade relationships with the rest of the world, if it's tariffing more of its imports, then more of the pressure is going to be overseas. So this often comes up in the context of what does it mean for the dollar, right? And the Trump campaigns talked about the desire to have a weaker dollar, but some of these policies we think at least initially would manifest in a stronger dollar because it's putting more pressure on the rest of the world. Then the central bank dovishness you'd see overseas would outweigh what it would do to the U.S.
Most people talk about also in the context of what it means for U.S. consumers. But if you look at the rest of the world, who would win in that scenario?
Well, I think it's complicated to say that there are specific kind of winners and losers. What I'd say is if over the long term, if the U.S. is pursuing more protectionist policies in the aggregate, which it probably is regardless of who's president, it's just a matter of tactics. Republicans clearly want to lean more on tariffs. But what it does is create this long-term incentive towards nearshoring, reshoring, et cetera. And the places that are best set up for that, I think, are the ones that we know for the most part, right? Mexico, if you go into Asia, we're talking about Vietnam or maybe Turkey and MENA, because these are areas where you have to kind of recreate the labor supply and the labor cost elements that you have in China, but you can't do it in one place. You have to, if you're a multinational, you have to kind of do it in the aggregate in the multiple different places.
You have a hard job, especially at a time where people are saying it's basically a toss-up and nobody really knows what's going to happen, and people are coming to you to explain what's going to happen, and you say, I have no clue. But I am curious about whether it's getting easier in this one sense. The two parties are kind of coming to the same place. That increasingly it looks like the policies are very similar to one another. And you just talked about how there are going to be protectionist policies no matter what. Is there a baseline of how much this gets accelerated, regardless of whether it's Harris or Trump?
Yeah, I mean, so again, if we're talking about trade, the real difference is in the short term on whether or not you're using tariffs, right? And if that's true, then the real difference in 2025 is, are we pursuing trade protectionist policies that have tariffs or don't? The end state might be very much the same, but in the short term, the tactic of using tariffs just creates a lot more volatility and a lot more uncertainty around growth. And then to the extent that you've got a Republican pursuing those policies, maybe they're going to deliver something on the back end in 2026 that's helpful to the economy in terms of greater fiscal expansion. But the sequencing here is important because you might very well go through the tougher, more risky stuff up front.
And then you want to talk about corporate taxes. Now, we can have the tariff conversation. It's a bit easier because we don't have to talk about the makeup of Congress. When it comes to taxes, we do. Let's talk about how workable things are. Yeah. Harris is saying take things from 21 to 28. Trump is saying take things from 21 down to 15, but with a lot of conditions. Yeah. I imagine you fielded a lot of calls yesterday from clients. What did you tell them about how workable the Trump plan is for a corporate tax cut?
I mean, it's the workability of any of this is really a function more of politics than anything else, right? At the end of the day, all of these tax plans are going to have to pass through a budget reconciliation process that in some ways starts with party leadership deciding what number on the deficit expansion are they comfortable with. And then everything kind of fits inside of that. That's effectively what happened with the Tax Cuts and Jobs Act in the negotiation in 2017, where Senator Corker said we can do $1.5 trillion on the deficit, and then everything kind of fit in from there. So I think these proposals are important to talk about, and we have to pencil in assumptions for them. But how workable is 28% on cap gains as opposed to something higher? Well, that's really a function of what does the party decide in the aggregate they're willing to do on the deficit, and then therefore what is it they feel like they need to pay for and what levers they have to pull from there.
There's a ton of proposals that are coming out of both sides, exempting on Social Security taxes, expanding child tax credit, which seems that both individuals want to do. What do you think is your base case actually gets done if we have a divided government?
Well, in a divided government, I think you can expect at least some of the kind of commonly supported provisions that are set to expire instead of the Tax Cuts and Jobs Act get extended. and then mostly kind of everything else goes to the wayside. So when we add up what we think are kind of commonly accepted provisions, it adds up to about $1 trillion of incremental deficit expansion over 10 years starting in 2026. That's where we think the bipartisan angle is. If Republicans sweep, we think that number can get as high as $1.6 trillion. If Democrats sweep because they'd be more willing to bring new revenue to the table on the tax side, that number could be like 500 to 700 billion instead. So really, I think we have to think more in terms of kind of the values and the principles each party is bringing to the table. The precision on the numbers is going to follow later after we get more details.
Okay, but I want to build at this, though.
Yeah.
And this is what we were talking about with Tobias Marcus, too. I mean, we talk about the lack of clarity around some of these numbers that we get and the details that are yet to be worked out. And yet, House after House has come out and said that Trump is going to increase the deficit more than Kamala Harris. We have a number of Republican strategists as well as people who could be his advisors who come on this show and get very angry. And they tell us that we're not accounting for growth that will come on the heels of some of these tax cuts, et cetera. What's the argument against that? Why is that not being included in any of this?
Well, I think there's a technical argument and then there's a more speculative argument. The technical argument is that the way the government's going to score any of these things typically is not going to account for incremental growth or dynamic scoring, as they like to call it. And so investors kind of not having certainty on that, particularly bond market investors, are really going to project or sort of discount to the present. What is the expected deficit projection that the government is telling them? That's going to factor into supply. And so the idea of sort of future economic growth kind of mitigating that deficit impact to like T plus 2, 3, 4, or 5 years later feels quite speculative, and it's not something that you can work with from an investment perspective.
Bank of America this morning said the most important NFP and most important debate of the year. That's what we're waiting for. The debate's important because we still don't know all of Kamala Harris's policy proposals. What are you most interested in trying to understand from her economic plans?
Yeah, I mean, I would love to hear more precision on both the tax and the spending side. I don't think you're going to get more of that from either candidate, though. And campaigns a lot of times are about putting your values out and expressing them in statements as opposed to specific policies, because that's going to be more persuasive to voters. So I'm obviously going to watch carefully what happens on the debate stage next week. I personally have low expectations for us learning more precisely what each candidate wants to do.
Have you developed much of a sector focus just yet, or is it still too early?
Well, I think there are some sectors that clearly sort of benefit or benefit less in either outcome. To the extent Democrats have more control, a lot of the sectors that benefit from the IRA, particularly clean tech, are going to be more secure because that spending is going to be more secure. If you have Republican sweep and therefore more of a skew towards extending more of those tax cuts, that skews more towards domestic industries, a little more towards small cap. I think it's one of the reasons that when it looked like Trump win probabilities were going a lot higher following the June debate, you started to see signs of life in small caps, and that's kind of come back as things have gone to more of a toss-up.
This is what Dan Greenhouse said yesterday on this program.
Yeah, essentially, that when you start to look underneath the hood, and this is what we heard also from Trump's potential advisor, that they're going to freeze some of that funding for the IRA, and that could end up really hurting particular areas, which is the reason why you're seeing some sort of shifting around the candidates.
To speak almost exclusively for the investor class, I think the way they view things at the moment is that Harris needs Congress to do some of the bad stuff, hike corporate taxes. Trump doesn't need Congress to do some of the bad stuff. He needs Congress to do some of the good stuff to offset the tariffs. So ultimately, I think the things as they stand are Harris needs a sweep, and that means that's bad for markets. And if Trump doesn't get a sweep, that's also bad for markets. Fair enough?
Sure. I mean, I think that right now, what I find most interesting is that regardless of whether that's good for markets or bad for markets, it's when it will be good for markets or bad for markets. And the fact that Michael Zezas is saying that essentially the sweeteners will come later because it will take longer, to me is indicative of, will the Trump trade look different this time around?
Mike, this was great. It's good to see you, sir. Complex stuff. Mike Zezas there of Morgan Stanley. Up next on this program, Cleveland Cliffs back in a conversation as speculation grows over the future of US steel. That stock is up by 2.8%. The opening bell 2 hours away. The jobs report 60 minutes around the corner. 3 days of losses on the S&P 500. Here is day 4 for now. We're down by 0.6% on the S&P, down by a little more than 1 full percentage point on the Nasdaq. The Russell down by 0.5%. In the bond market, what a week already. Down about 20 basis points at the front end of the curve on both the 2-year and the 10-year for that matter. We're down another 3 this morning. The 10-year 369.86, the 2-year 372. Last time we were going into a payrolls report only a month ago, Lisa, that one had a 4 handle.
And we have a totally different perception now of the balance of risks, at least in terms of the reaction function for the Federal Reserve. People now talking about not just a 50 basis point rate cut this month, but a series of them, which we heard from Citigroup and then JPMorgan even potentially talking about that. Question to me is, at what point does the Fed worry about spooking a market that already is a bit on edge, concerned about more significant weakness?
You can feel it. Think about how much weight we've put on the bad data this week compared to, say, the good data. And I use the word bad loosely. Let's talk about downside surprises on things like the ADP. ADP was the weakest number since 2021. Job openings the lowest since 2021. Not the kind of news you want to see if you are, say, looking for higher bond yields. Then you look at the ISM services print, pretty decent. Jobless claims, nothing to see here. But we haven't spent too much time talking about that in the last 24 hours, have we?
No.
That was the good stuff.
Well, the good stuff is sort of being ignored because it's A, backward-looking, and B, a lot of people are saying that the forward-looking indicators are weakening faster than people previously expected. We heard this from Austin Goolsbee overnight in a discussion with Market Watch. We've heard this from Mary Daly of the San Francisco Federal Reserve. And you get the sense, particularly in the beige book, there's certain areas that are just starting to roll over, and that never happens linearly, to use a fantastic word coined on the show today.
For foreign exchange, switch on the board. There's only one currency pair we'll all be looking at 8:30 Eastern time. It's dollar-yen. Yen strength for a 4th consecutive day. Dollar-yen down for 4 straight days. Back to about 143 right now on this currency pair. This was one to watch last time around, much more so given the moves we saw on August 5th, just a few days after that jobs report a month ago.
And the economic data is moving in the opposite direction in Japan. Let's just point out the fact that wages actually increased more than expected, even as they increased less than expected over the euro area, and people are talking about a flagging labor market expansion in the United States. At this point, can we be talking about diverging cycles that benefit the yen in an exact reversal of the consensus trade just a month ago? I mean, that's what Mark McCormick was talking about. How fast this has moved has been really notable, and you wonder how much the sort of corollary washout has actually already happened.
Dollar yen at 143. Under surveillance this morning, then our top story, the US payrolls report for August, just under an hour away. The median estimate in Bloomberg survey calling for 165,000 jobs added. The unemployment rate expected to tick down to 4.2%. One of the most important events taking place this week was something Mike McKee mentioned earlier on. Mike McKee talked about 11 o'clock Eastern time on Friday morning being a key time. Why? Governor Waller set to speak before the quiet period. How they frame whatever that jobs number is at 8:30 could go a long way to shaping expectations into the weekend and into September 18th.
If he uses the word moderate, there's your 25. If he talks about the importance of aggressive actions to get ahead of things, well, there you go. And basically, that's what you're going to be looking for. Look, it's really interesting to me that it's coming at that point. We also get the 8:45 speech from John Williams. Does this mean that they actually want to give a signal to markets, or are they just going to talk about, vague niceties?
I'd point out a few things. A lot of the language, some of the buzzwords in the Fed speeches over the last month, methodical, gradual. If you start to hear more of that again after the jobs report, whatever it is, methodical, gradual to me means 25. They open up the conversation to start saying things like, we're not restricted to only going 25 when we prove that in the other direction when we started the hiking cycle. Let's see what kind of language they use. I still stand by this, that there is some daylight between the conversations we're having on this program and the language they're using in the Fed speeches. They're still talking about gradual. They are not mentioning things like 125 or lower would mean we cut rates by 50 basis points. That is something of the market's own creation. There's a lot of daylight between these conversations and what they're saying. And maybe they close the gap in those speeches a little bit later. But for now, there is a gap.
There is a gap. It also has been moving very quickly. And we have to note that the data has been moving quickly and the conversations that we're having with people are moving quickly. I can't think of a person who is talking about 150 basis points being cut in terms of the Fed funds rate over 3 meetings, just casually, as almost a consensus call or an increasingly non-controversial one. And yet here we are. So it does feel like things are shifting pretty rapidly.
Look how low the bar is over at Citi. Great conversation with Andrew Honhorst earlier on this morning with Danny Berger and Manus Cranny. Andrew Honhorst has continued to say that all we need is 125 on payrolls, 4.3% on unemployment, which is where we were last month, and this Federal Reserve goes 50 on September 18th. That's a pretty low bar.
All you need to see is that there isn't payback from the July jobs report, that it wasn't necessarily a fluke or just weather, and suddenly people will start to count it as something meaningful. And that, I think, is the point that he's trying to get to.
Let's keep it on the labour market with this story. A union representing dock workers from Houston to Boston saying it will back a strike if their labour contract expires at midnight on September 30th. Talks with terminal operators and ocean carriers have stalled since June. Sticking points include higher wages and use of automation. Port of LA Executive Director Gene Soroka joining us on Tuesday, so we'll explore some of these issues. For the ports just across the nation, he's gone through it himself in the last few years, but this is another sticking point for unions in the labour market in this country.
And the timing could not be worse. It's coming not just ahead of the U.S. election, but also ahead of the time where you see these ports really start to have a buildup because of the holiday season. So this could not be worse for the current candidate, who is an incumbent, Kamala Harris. Sticking points, as you mentioned, Jonathan, are really everything: automation, healthcare, retirement benefits. This is what we heard from the West Coast. Some analysts believe the final agreement will exceed what they achieved on the West Coast, which is 32%. So basically, they're saying they're willing to go. Again, the timing is pretty brutal.
It's interesting to me to see this sort of last gasp with this timing, how much they're sort of relying on the political pressure to get this through, because we're not hearing a lot about strikes. Remember, say 2-3 years ago, when there were strikes everywhere as wages were increasing at a really rapid pace. This is the anomaly, not the norm right now, because the power has adjusted more significantly toward the employer and not the employee.
We've lost some labour leverage, that's for sure, but still seeing some of these issues on the fringe. Are they going to be things we see in the rearview mirror just a little bit more and maybe not on the horizon? I agree with you. Much more leverage maybe, say, a year ago than the kind of leverage that's out there at the moment.
I just wonder how much this is trying to leverage the political moment to say, actually, this is very good for us to get this done. And so why don't we do this right now and increase the pressure, and not necessarily because of the inflationary pressure that gives them that ability.
Reading the political tea leaves quite poorly, those operating in the steel industry. Cleveland Cliff CEO saying he's still in the market for US Steel. Lorenzo Concalves saying he's working on a plan to buy the firm if a deal with Japan's Nippon Steel falls through. President Biden expected to block the deal. Bloomberg's Josh Wingrove joins us now from Pittsburgh. Josh, walk us through how delicate, how finely balanced this conversation has become in the last couple of days after the US Steel CEO essentially threatened job cuts if this deal doesn't go through.
Yeah, good morning. Lorenzo doesn't really do delicate very well, so let's put the comments from Cleveland Cliffs aside for a moment. We just had everything sort of unload in the last week, including reports of a letter that went to the company from CFIUS, sort of detailing objections, I suppose, and then the company's really sort of, emptied the chambers in terms of all the stuff that they were hoping to do or threaten, and that includes offering a majority American proxy board, which is a nod to the calls from Biden and others that the company be American-run. I suppose, how do you slice that? They're trying to thread some kind of needle. And, of course, the threat that, hey, nice headquarters you got there, nice plant you got there, be ashamed to lose that. They might pull up stakes if this deal falls through. We spoke with the head of the United Steelworkers yesterday. He's sort of just brushing it off, saying this is bluster, the company won't leave, these plants won't close. But there's a lot of moving parts here right now. There's also a question of when is this happening? We've reported as soon as this week. But Governor Shapiro of Pennsylvania said yesterday that there are essentially some kind of talks ongoing to protect those jobs, quote unquote, protect those jobs. And so now the question is, does that mean the governor is trying to walk Joe Biden back off the ledge? It's unclear. So right now the White House is super quiet. CFIUS is just this black box process. And, I'm here in Pittsburgh on the road with the vice president as she does debate prep. She weighed in for the first time on Monday, hasn't touched it since. So a lot of things swirling right now, but Biden has been clear that he wants the company to be American-owned and American-run. And so the question is he bluffing?
But, Josh, he can't block it legally until that CFIUS review is done.
Yeah.
What is the timeline at all to wrap up that type of review?
White House officials have said they haven't transmitted the review to the White House. I think that's an important word. It doesn't necessarily mean that they don't know what the decision is, or, that they're not expecting it coming around the corner soon. But they do need that to go there. We've also learned from CFIUS experts over the 9 months covering this that CFIUS itself, at least the panel, would probably be unlikely to block a deal like this with an ally country But the sort of final panel includes members of Biden's cabinet, and ways that things can hit his desk is if there's a split decision. So it's not clear whether that'll be the case here. In other words, do they just sort of throw their hands up and be like, send it to the boss's desk? That could be it, as opposed to the whole process finding a problem here.
Well, based off past CFIUS reviews, what they usually do is they outline, it's a menu of potentially actions you could take. What actually are, you mentioned Japan's an ally, what actually are the national security concerns that your sources are telling you about this deal?
There's a few. Some have included the supply chain impact vis-a-vis China. Nippon Steel has some sort of downstream stuff in China. The question has been, well, will they have to divest those? That doesn't seem like a bigger sticking point. More broadly, they're just using the argument that steel is a sector that is itself a national security concern. This has been sort of a building thing, right? Trump's 232 tariff. We've sort of seen steel increasingly treated like some secret high-tech new thing that needs guardrails around it. And so I think that is where they're saying it, just the very simple nature of U.S. steel being foreign-owned hurts American security if you ever needed to, rely on these countries to import the sort of raw steel that you would need from these blast furnaces, in particular, roads, bridges, all that kind of thing. So it is a broader argument, steel as national security, rather than something that seems to be focusing in on, hey, what about those plants in China?
Josh, the more I read about this deal, the more fascinating it gets, because essentially it gives a test to the Kamala Harris campaign of what's worse. Is it the idea of international interference and the desire to have a more protectionist policy? Or is it the potential monopolistic tendencies in specific industries with, say, a Cleveland-Cliffs acquisition that she's seeking to prevent? I mean, which do you think is sort of the emphasis here?
I think for her right now and for the Biden administration in the last 9 months, it's union jobs, union votes. The steelworkers are against that. I don't think it's just that. And I think, you talk about Cleveland-Cliffs earlier. Another thing is here, if they try to buy some of these assets, in particular the blast furnaces, which are the unionized part, that's going to create a market consolidation that we've seen the auto sector warn about. I mean, we've had Pennsylvania's lawmakers flipping out over this deal. If you start messing with the auto sector, well, I think we'll see Michigan's lawmakers flipping out in the opposite way. So there's no clear, real alternative here other than maybe U.S. Steel simply remains U.S. Steel. And that's where the CEO's warning comes in. Again, the union doesn't buy the warning, but the CEO's warning this week being like, these plants need investment. Not only is Nippon Steel offering $14.1 billion, they've offered $2.7 billion additionally on investments to keep those plants going. Without this deal, we don't have the money to do it. And so read the writing on the wall. Now, I should also note that the allegation from the union is that Nippon is willing to pay this premium simply because they've got excess capacity abroad. They're looking for a place to park it, and the union alleges the plan is to sort of dump that here in the U.S. if they succeed in this deal. So it's tough. It's like you have the foreign offer, you have staying independent with the CEO warning they don't have the cash to keep things going the way they should, and you've got other domestic offers that create antitrust concerns that other industries like autos are going to flip out about.
Could be a big issue on the debate stage early next week. Josh, thank you, sir. Josh Wingrove there of Bloomberg on the latest in the steel industry. Let's get you an update on stories elsewhere. Let's take the opportunity to get you a Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Software billionaire Larry Ellison will take control of Paramount Global after a group led by his son, David, complete the purchase. The Oracle co-founder is backing his son's $8 billion proposal. A filing shows he'll take almost 78% of the Redstone family's interest in the film and TV company. Sources tell us Sherry Redstone will get $180 million in severance and benefits from the deal. That's on top of hundreds of millions more from the sale of her stock. Warren Buffett extended his sale of Bank of America shares into September, a total now of $7 billion since he started selling about 2 months ago. The latest round of transactions, Berkshire Hathaway liquidated $760 million of the stock this week. If Berkshire keeps selling, its stake in the bank could soon slide below 10%, the threshold where holding reports are no longer required. Buffett began building Berkshire's investment in Bank of America with a $5 billion deal in 2011. Boeing's Starliner is set to head home without its astronauts from the International Space Station as early as 6:04 p.m. Eastern today. In a statement, NASA said detailed checks concluded that the homecoming can commence pending weather and operational readiness. The spacecraft is returning to Earth after an orbit that began on June 6 and was only supposed to last 10 days before machinery problems were found. The astronauts are set to return months later on a February 2025 SpaceX flight. And that's your brief. John.
Danny, thank you. Lots to unpack here. One, I still can't believe there's two people stuck in space and we're just like, they're coming back in February. Two, can you imagine Daddy buying you an $8 billion company? Just like that? Can you imagine that?
Well, considering my personal experience where Daddy buys... I can't even say it. I can't even say it.
Can you buy me AC Milan?
Yeah. Are you actually asking? Like, please, whoever, somebody out there, bless me with that. I mean, essentially.
Absolutely ridiculous.
Yes, this is the story.
Up next on the program, slowdown fears mounting.
What looks like a soft landing, what looks like a very slow softening of the U.S. economy tends to accelerate.
The View from Bank of America, up next. The jobs report, let's call it 42 minutes away. Equities softer, negative by 0.6% on the S&P. In the bond market, yields down 2 or 3 basis points, 370 on a 10-year. Under surveillance this morning, slowdown fears mounting.
If you look at some of the survey numbers, people are saying they're finding jobs harder to get. They're more worried about losing a job. I think we will see the unemployment rate that not only moves higher, but accelerates higher. What looks like a soft landing, what looks like a very slow softening of the U.S. economy tends to accelerate.
So here's the latest. August payrolls coming in just about 30 minutes' time. Bloomberg survey calling for 165,000 jobs added for unemployment to tick slightly lower. Aditya Bhave of Bank of America Global Research looking for a bigger print, but remaining cautious, writing the following. We expect payrolls to rise by 200,000. Despite our strong forecast, we do not think the labour market is accelerating. Add to that the solid activity data, and this leaves us comfortable with our base case of a soft landing. Aditya joins us now for more. Aditya, welcome back to the programme. Let's get into this. I've heard the weather come up in conversations. I've now heard, reading your research, retooling plants in Michigan. So can you walk us through those two issues and the kind of payback we could get in this report because of them?
Right. Good morning, first of all. Thank you for having me. So the issues there were a number of idiosyncratic factors that I think made the July jobs report look a little weaker than it otherwise might have been. With the weather, it looks like in Texas there were a lot of folks on temporary layoff probably related to Hurricane Beryl. With auto retooling, there's a similar story in Michigan, right? So we expect payback for those factors, and that's one of the reasons we think the unemployment rate falls back down to 4.2% in 40 minutes.
And another reason why you think they go 25 basis points on September 18th. So, Aditya, I've got to ask you, what would change your mind in 40 minutes? What would make that 25 a 50?
So we've written about this. We think if the jobs report is really, really very weak, and I'm talking about, double digits on non-farm payrolls, maybe sub 50,000, and the unemployment rate going up, then I think they would seriously consider a 50 basis point rate cut. And they would basically have to tell us. I think the markets would price it in, and they'd have to confirm that or deny it when New York Fed President Williams and then Governor Waller speak later this morning. But it is important to remember that if they cut by 50, they have to understand that the markets are probably going to price more 50s down the line, right, in November and December, and they have to be ready for that. And for us, that is a pace of rate cuts that's consistent with a recession. So you cut 50 if you think there's a recession, but if you don't think there's a recession, you probably want to cut at a more gradual pace.
Priya Misra of JPMorgan was just on talking about how it's not really her take on what the market is pricing in. She doesn't see the bond market saying there's going to be a recession by pricing in more cuts, but just that the neutral rate is going to be that much lower and that the Fed is going to get there more aggressively now, just simply because you have seen some deterioration in labor markets. Why do you disagree with that?
So what I would say is, yes, it's possible the market is pricing down the neutral rate, but when the Fed is cutting to normalize or it's doing a mid-cycle adjustment, it cuts relatively gradually, right? 25 per meeting, 25 per quarter, something like that, because it doesn't want to convey a sense of panic to markets. Because when you do that, it's almost counterproductive. Then you're no longer supporting financial conditions, right? Because markets think, well, maybe the Fed knows something that we don't know. So 25 basis points if you're normalizing, but when you're cutting 50s, you're not just cutting to get back to neutral. You're probably cutting to get below neutral and actually accommodate the economy.
There's a sense that we've heard from an increasing number of guests that the labor market is actually quickly shifting away from being strong to something much less so. We were hearing just from Austin Goolsbee overnight in a Market Watch interview that actually he sees the data moving more than the Fed officials had expected. What are you saying? What are you seeing in there, the data that seems to reject that points to stability, to strength, to something that really kind of flies in the face of some of these more extreme rate cutting projections?
So we'd point to a couple of things. The first one is the resilience in consumer spending. So if you look at the last 4 or so months, spending has actually accelerated. It's probably running at around a 3% pace, which is above trend. That suggests, one, that the income that's being generated, regardless of what you're seeing in the official data, is sufficient. And two, that solid demand should continue to support decent job growth going forward. The other thing we would point to is we've had a lot of catch-up employment growth in a few sectors: leisure and hospitality, healthcare and private education, and government, right? So those sectors are slowing down. But if you look at the remaining job market, it's kind of just been running flat, right? There isn't clear sign of deterioration. And related to that, layoffs are also still very low. So that gives us hope that the labor market is still just normalizing rather than outright weakening.
Aditya, when you talk about the consumer spending, you think is healthy. What do you make of these CEOs that come out and say, though we do see consumers being choiceful or picky, that they don't still have the same kind of, impulse that we did see a few months ago?
Right, so there's definitely going to be idiosyncratic companies and sectors that are more affected than others, right? In a trend-like economy, a good chunk of the economy is running below trend. And that's going to affect certain companies. But if you look at the aggregate data, which I think is the best that we can do, then things looked a little soft at the start of the year. But May, June, July were pretty good months, right? So overall, all we can say is spending's holding up. There's also this possibility that, what you see in the stock market is not necessarily representative of overall consumer spending. A lot of consumer spending happens in service sectors that aren't well represented in stocks.
Aditya, before you go, I just wanted to get your thoughts on Governor Waller, who speaks ahead of the quiet period. The Fed speaks so far, we've touched on that. What are you looking for from the Fed officials going into the quiet period?
So we really like listening to Governor Waller. We think he's probably the second most important voice on the Fed. And part of that is because he's very forthcoming in answering questions, right? And he's very direct with telling you what his view is. So we would expect, if the markets are somewhere between 25 and 50, we would expect clear guidance from Waller. I think if you're close to 25 or 50, you've probably gotten a strong enough signal from the jobs report that you don't need Waller to take a strong stance. I mean, there is some tail risk that he'll have to jawbone the markets, but I don't think that's necessarily the most likely outcome.
It's an event to watch, that's for sure. Aditya, one of the best, one of the very best. Thank you for being with us, sir. Aditya Bhave there of Bank of America Global Research, looking for 200K on payrolls in 35 minutes.
Talking about payback from the last report and then also just this ongoing resilience. One thing we haven't talked about, revisions to the prior month, revisions to the prior several months. What happens if they come in significant and actually downwardly revise some of those data points? These have been messy numbers and they've been moving quite a bit.
The other revisions we haven't talked much about, the summary of economic projections gets an update September 18th. They've got unemployment year-end at 4%. Year-end 2025, they've got it at 4.2. Year-end 2026, they've got it at 4.1. Aren't we due a revision on that front as well?
Especially at a time where we're hearing from Fed officials that the data is moving a little bit more quickly than they previously expected. And guess what? We're already well through the unemployment rate.
Get a brand new dot plot as well. So lots to get excited about on September 18th.
Keep it down. Keep it down, John.
The next hour looks like this. Nadia Lovell of UBS, Michael Collins of PGIM Fixed Income, Jeff Rosenberg of BlackRock, and Torsten Slok of Apollo. Am I getting too excited?
Well, can I just say that I know people who make dot plot cupcakes.
Did they?
Pass them out, yeah. I remember that in the Bloomberg newsroom.
Someone did that in the newsroom?
Someone did dot plot cupcakes.
That's quite sad.
Yeah, I didn't really understand.
Do you want to name and shame now, or you want to tell me the commercial break?
We'll discuss in the commercial.
Okay. And then everyone gets to guess. From New York, this is Bloomberg.
the unemployment rate moves up again, if you get a significant rise there, I think that's going to be a pretty worrying signal.
We're looking for north of 200K. Very importantly, a decline in the unemployment rate.
If we see a number closer to 100,000 this month, then we'll have to reassess our sort of view on the labor market.
It would take, we think, a pretty significant downside surprise to drive markets much lower.
There's no magic number here. It really is about the direction. And we should expect to see more softening in the labor market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So this is it. This is the hour. The jobs report 30 minutes away. The estimates look like this: 165K, the median estimate in our survey for the headline payrolls print. For unemployment, looking for that to drop back from 4.3 to 4.2%. The jobs report just around the corner. The opening bell 90 minutes away, and the scores look like this in the equity market. A 3-day slide looks like it could become 4. We're down by 0.5% on the S&P 500. On the Nasdaq, down by 0.9. In the bond market, a 20 basis point move on a 2-year and a 10-year so far this week. The rally in fixed income, Lisa, continues.
And really, to me, this is the most pivotal jobs report of the year. And we don't always say that, but to me, this really marks the difference in terms of the tone, the tenor, and the speed of the Fed's rate-cutting cycle. People have said this. They've doubled down on it at a time where the time has come to start cutting. Now the question is to where and how quickly.
It won't determine whether they cut, but by how much.
Correct.
That's been the feeling for a while. What we need to gauge over the next 30 minutes, though, just get a clearer idea of how low that number needs to be to really cement this idea they go 50.
Well, what people are talking about is what is the unemployment rate? How much does it come down or does it go up? Because that's also going to determine some of these other factors like how big is the labor market? What is a good number? Things that we don't have a clear sense on. And then we aren't really talking about this, but we should. Downward or upward revisions to prior months of data, because we have seen a lot of messiness there. And if they upgrade last month's data to become better than it was, well, then we don't have the same kind of trend. But if they downgrade it, just watch. All of a sudden, you could get very different language from Chris Waller and a very different response from markets.
On the heels of that 800,000 downgrade we recently had, it feels like we have this spectrum of, we just heard from Aditya, 200,000 on the payrolls increase. That's 25. Andrew Hollenhorst, we heard from this morning and just published, he expects below consensus 125 new jobs, unemployment holding at 4.3 to be enough to go 50. It's that range on whether or not potentially it may push the Fed.
And it's not a big range. Let's be clear about that. Was the 4.3% unemployment, the 114 on jobs, signal or noise? Can you really point to factories in Michigan retooling, to weather issues down in Texas as a reason to expect big payback in 27 minutes? The people looking for the 200K type numbers, that's what they're expecting.
To me, it seems like the question is also what the read-through is for the longer-term trajectory. The 200,000 crew believe in the soft landing. They believe that weakness that we've seen in the market is not something that is going to be more protracted and deeper and nonlinear. The people who see 125, the Andrew Hollenhorsts of the world, 125,000 and a greater chance of recession are those who see a quickly moving market to a different lower shift. And to me, that is the reason why suddenly you have Citigroup talking about this Fed not taking baby steps on the way up. Why should they take baby steps on the way down, especially if you see deterioration that continues to rear its head?
8:30 Eastern Time, 26 minutes away. Equities right now just off session lows on the S&P 500, still down by 0.5%. In the bond market, yields lower by 2 or 3 basis points, 369.86. The currency pair to watch, dollar yen. 4-day slide, 4 days of yen strength. How much more yen strength can we generate off this story in the U.S.?
Well, not just the U.S., also the other side. Actually, quite a bit. And here's the issue, and you've raised this before. Have we really blown out all the longs? Are we really done with that trade? Or could that be another disruption akin to what we saw August 2nd when we got the other labor market report at a time when we still saw a pretty big leveraged trade position?
Late start to the weekend for those of you in Japan. Good evening, Tokyo. Said this so many times, haven't we, over the last few months? Coming up on this programme, Nadia Lovell of UBS on why markets can continue to grind higher. Mike Collins of PGIM Fixed Income as traders see a growing chance of a jumbo September cut. And Torsten Slok of Apollo reacting to the jobs data. We begin with our top story. August payrolls out in just under 30 minutes' time. Data expected to determine the size of the Fed's next move. Nadia Lovell of UBS saying the soft landing remains on track. The labour market will cool gradually rather than contract. We continue to expect the Fed to start rate cutting in September. Base case, 100 basis points in 2024. Nadia's with us for more. Nadia, good morning to you.
Good morning.
Last time we were with you, it was right before that payrolls print on August 2nd, 30 minutes before, and you were talking about the prospect of a soft landing. Has anything changed in your view with the data we've had in between those conversations?
I don't think largely, no, we wouldn't say anything has changed. We are still in that soft landing cap. There isn't any indication to us that the economy is decelerating at an accelerated pace. Of course, we're all watching payrolls, just given the weakness in July. But so far, weekly jobless claims has been well behaved. And what we're hearing from corporations, we're not really hearing any sort of broad-based slowdown. I mean, I know there was a consumer conference this week, and Lisa, you were at some. What I'm hearing from our consumer analysts is that the tone has been fairly constructive and seeing some positive data points coming out of consumer in August.
So if you expect growth to hold up and rates still to come down, why aren't you all in on small caps, all in on discretionary?
So a view on small cap has more to do with the sustainability of any sort of earnings growth in small cap. A lot has to go right, come together for the small cap trade to work. And quite frankly, some of it has already run ahead of itself. Small cap also needs the manufacturing part of the economy to cooperate. We haven't been seeing that in terms of the ISM manufacturing has continued to be weak. This is why we continue to lead into large cap because of a secular growth. Now, while I say that the economy isn't coming to a screeching halt, it is slowing down. 2% growth is still good, but small cap also needs that Fed to be a little bit more aggressive in terms of reducing rates for it to work.
I can just feel in the back of my head all the people calling you up. Do I just buy all the NVIDIA that I possibly can get? Is that essentially what you're saying?
Absolutely not. I mean, we have taken a more balanced approach in our sector position. And just given reality is, yes, there are parts of the economy that are still weak and feeling the pressure of restrictive monetary policy. So we do think that it is important to anchor in secular growth in tech, add some cyclical in financials, and then also a bit of a defensive exposure in utility. So right now we're in this phase where you want to be a little bit more balanced because, yes, the data is a little bit murky.
I want to just go back to this idea where you expect the Federal Reserve to cut by 100 basis points this year, and yet you still see a soft landing. You still see the S&P 500 ending the year at 5,900, again, from where we are now. Can you square those two ideas, that the Fed could cut pretty aggressively, and yet that doesn't necessarily mean that they see real trouble?
Yes. So in terms of the 100 basis point cut that our economist has penciled in, we're all data dependent. A lot is going to depend on payroll. Where we sit today, we'll know in a few minutes, it does feel like it's probably more of a 25 basis points cut to start off in September. But we want to maintain that optionality because we know that the data can shift quickly. So that 100 basis points cut could be more 75 basis points cut. Now, in terms of what you're seeing from the corporate side, you are seeing corporations holding in. Q2 earnings beat expectations. You're not seeing much downward revision to the forward estimates. So that's why we think that this market can continue to rally. Now, that's not to say there won't be near-term volatility. Right now, investors are on edge. And so far, it's been a good year. So you could see some people continue to take profits. You need that clarity. So we think the next couple of months will be volatile. But once we get into third quarter earnings as well as into Q4, we think that this market will start to regain its footing.
Once you want to buy ahead of that, what do you like right now?
Right now, tech, we continue to like tech, as I noted earlier, but we do expect some volatility in tech. And so we have been encouraging investors and clients to get that shopping list ready. And what's on that shopping list is going to be quality. We would be leaning into those AI logic chip names and also some of the foundry names. We think that the AI story is still largely intact. CapEx continues to move higher. And I know that there are questions, of course, around return on investment capital, but you are seeing use cases come through. Speaking of NVIDIA, we did hear NVIDIA say 40% of its data center revenues over the last 12 months came from inferencing. That's actually tied to model usage and actually tied to return on investment capital. Walmart also talked about, using AI and, for their projects. And if they didn't, that would be 100 times more headcount that they would have needed. It will take time, but we're seeing evidence of it.
I guess one of the uncertainties, and we've seen people struggle with this all year, is just how much rate cuts are going to support further gains in equities. And you're saying that there is a possibility that it could be 75 basis points of rate cuts, but there's also a possibility of 150 basis points of rate cuts. Would that be bad for stocks?
Yes, we do think so near term. Now, because it would suggest that something is breaking or has broken and the Fed needs to accelerate. We want the rate cuts to be gradual. We want it to be a marathon, not a sprint. If we're in a sprint, the equity market will react to that because now it's concerns about what does that mean for corporate earnings and what does that mean for growth going forward. So I think, if you get between 75 and 100, that's probably more palatable to equities than if you get 150 basis points.
We know what you like. One of your least preferred sectors is real estate, but we have rate cuts happening basically around the block. On top of the fact that Washington, bipartisanship, we're seeing, talking about the housing market. What would it take for you to maybe like real estate?
I think what we need to see is that the estimates come down a bit more. Real estate has started to perform better, yes, and I think it has run ahead of itself in terms of anticipation of rate cuts. There are still some capacity issues within real estate that we think that will start to filter through the earnings. So we think that there's a bit more downside to earnings and, FFFO. In terms of the other areas that we also are a bit cautious on, materials. We know that that's very much tied to China, and the data is just not coming in. It's coming in weak. And then also, we're not seeing any sort of real pickup in industrial gas volume. So those are the two areas that we're a little bit more cautious on.
The commodity market's been difficult, that's for sure. Nadia, thank you. It's good to see you. Nadia Lovell there of UBS going into the jobs report 20 minutes away. The estimate 165K. Neil Dutta of Renmac writes in. Here's a line from him. Whatever the number is, it's being overestimated. We've asked this question so many times over the last week. Should we just chop off 60 or 70K from whatever this number is at 8:30?
I mean, let's say it's 145. Does that mean it's 85? I mean, how much? And that's why we go to the downward revisions. How much will that matter? Almost just as much of prior months as the actual headline number that we get today.
Chairman Powell back in July poured cold water over some of these numbers as well, remember? That was before August, before the number. He was talking about some of these figures being overestimated. 165 revised down to what, 80? Is that what we're running with, 90?
Well, revised down 60,000. That was sort of the average. I will just say this. He knows something that we don't know.
Who, Chairman Powell?
Yeah.
What do you think of that, the signalling from this? That if they go 50, it's something to worry about. What do you make of that conversation?
It's so fascinating to me because I've heard both. I've heard that on one hand, if the Fed is aggressively or incredibly tight, restrictive, why shouldn't they go quickly? Why shouldn't they get down to a level that's more closer to neutral, just simply to adjust to where the economy is going? And then you have Drew Mattis writing in, going aggressively on the way up didn't turn out so well. So maybe baby steps or a sense of humility would be warranted. So you have both kind of coming out. Really, to me, one of the most interesting questions is, if they cut 50 basis points, is that negative for stocks?
I like the Coniston thought exercise. Blank sheet of paper. You came in from Mars and you asked yourself, what's the right interest rate for this economy, given where inflation is, given what the trend in jobs is, would you come up with 5.5%? Would you? I'm not so sure you would.
And if you came up with the more likely 4%, would you be okay with just saying, okay, well, why not just reset it there right now?
Jobs right now, we're looking for 165, the unemployment rate, looking for that to decline to 4.2% from 4.3. We'll settle all of this, maybe, at 8:30 Eastern time. Let's give you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Former Bank of Japan Governor Haruhiko Kuroda signaled that the BOJ has a lot more room to raise rates. He said that the nominal neutral rate could be less than 2%. After their most recent hike, the key rate sits at just 0.25%. Kuroda joins other ex-officials who've told Bloomberg that rate hikes could be faster than most expect. Dollar yen sits around 143. That is a lower level than the early August aftermath of the BOJ hike and July jobs report. ABC reporting that President Biden is set to sign an executive order today for federal grants that prioritize projects with organized labor. Biden will make the announcement at a union trading center in Ann Arbor, Michigan. The party and VP Harris's campaign have been trying to shore up union support. Along with labor agreements, the grants would prioritize projects with wage standards and benefits like access to childcare and apprentice programs. Bloomberg has learned that Intel is weighing a sale of a part of its majority stake in Mobileye. It's part of a major strategy overhaul to improve performance. Sources say Intel could offload some 88% of its holding in Mobileye on the public market or via a sale to a third party. Mobileye has a board meeting later this month in New York where Intel's plans will reportedly be considered. And that's your brief, John.
Danny, thank you. Back with Danny in about 30 minutes' time. Up next on the programme, we'll get you some morning calls, plus looking ahead to the payrolls report with Mike Collins of PGIM Fixed Income. That payrolls report 15 minutes away. The jobs report, 8:30 Eastern Time. We're looking for 165K. That's the estimate in our survey here at Bloomberg. The unemployment rate, 4.2%. That's the estimate against last month's 4.3. Equities negative by 0.5% on the S&P 500. In the bond market, the rally continues. Yields lower by 2 basis points. The 10-year 370.42. Let's get you some morning calls. First up, UBS lowering its Broadcom price target to 170 and keeping a buy rating. The analyst saying overall revenue guidance fell short of expectations. That stock lower by more than 7% in the pre-market. Your second call from JPMorgan downgrading Supermicro to neutral. The analyst citing a delayed 10K filing after the company said it needed more time to assess its internal controls. This has been building now for the best part of a week. We're down by 2% in early trading. And finally, KeyBank lowering its price target on Verizon to 44 and keeping an overweight rating following the announcement of the Frontier Communications acquisition. That stock is positive by, let's call it, 0.25%. Elsewhere, the focus firmly on the August payrolls report just a few moments away. Bloomberg survey looking for 165K and unemployment to drop to 4.2%. Michael Collins of PGIM joins us now for more. Mike, always special to catch up with you on Payrolls Friday, sir. Welcome back to the programme and good morning. The focus for you and the team, what are you focused on at 8:30?
Yeah, obviously, this could be a real market-moving jobs number, Jonathan. I think if it prints based on those expectations you just showed on the screen, I would bet short rates actually back up a little bit. There's a lot of rate cuts priced in. In fact, right now, as of this morning, the funds rate that's priced in just 1 year from now is all the way down to 3%, right? So that's 230 plus basis points of rate cuts in 12 months. It almost feels like you need something more than what we're seeing, which is just a kind of a gradual slowdown in the economy, a gradual weakening of the labor market. But to get those kind of rate cuts, it feels like you need something worse than that. So, a bigger number, obviously, the front end could back up a lot if you get a surprise on the upside because of all of these cuts priced in. If the number, prints below 100, I guess the front end rallies. I guess you can continue to see the curve bull steepening. But, man, there's a lot of cuts already priced in, so it feels pretty full to us.
There's just a feeling, though, Mike, whatever the number is, this bond market gets bought either way. There's just a feeling that that's the bias right now in fixed income. Do you sense the same thing?
That has been the bias, Jonathan, and rightfully so. The economy feels like it's weakening pretty quickly here. It's been kind of on a moderating slowdown, and it feels like maybe we're starting to hit this inflection point where demand is coming off harder. We had some big international trucking companies report really weak numbers this week, and that's really typically a good leading indicator for economic activity generally. The manufacturing sector broadly, Jonathan, feels like it's in a recession. So the jobs number, the labor market, is usually the last thing to fall, right? We looked at data this morning historically. The recession happens when the job number turns negative, right? So the jobs number is not a leading indicator. It is a coincident or even slightly lagging indicator. So given all of that, and obviously inflation, we're not even talking about anymore, right? It feels like it's dead in its tracks and stuck at 2% here, maybe indefinitely, maybe even going lower. So the bond market has been rallying because of all of this data. But again, there's a lot of cuts. There are a lot of cuts priced in. If you get an upside surprise, you could get a big sell-off in the front end.
Mike, it's funny because you're making the argument for why all of these cuts actually make sense and why you should lean into it. It sort of goes to this feeling that maybe we're going back to the environment that we left, of basically the neutral rate being substantially below where we are currently. And why not get the Fed to move more quickly to get closer to that, just to avoid that kind of falling off a cliff moment? What's the argument against that, Mike? What kind of number would you have to see to get behind some of the cuts that you're seeing priced in and then some?
Yeah, I think if you see, like I said, if you see the number come in as expected, I wouldn't be surprised to see some of those rate cuts come out of the market. Right now, there's over 100 basis points of cuts priced in for this year. So more than just 150 basis point cut. There's almost a 50% chance of a 50 in the September meeting. So again, pretty aggressive cuts. But that being said, Lisa, you're right. Like I said when I was on your program last time, I think the funds rate should today probably be closer to 3.5% than 5.5%, right? So if the Fed could snap their fingers and get it down to 3.5%, they would probably love to do that. But obviously, financial conditions would ease significantly So they have to be careful. They're really cognizant of financial conditions. I'm looking at yields on the corporate bond market today. I mean, they were at 6.5% not that long ago. They're at, about 4 3/4 today. The high yield market was in the 9s. It's at, just over 7%. I mean, we're getting back to much more historically normal levels. And companies, as you've seen, are issuing like mad. You're seeing a pickup in M&A activity. So definitely, animal spirits are alive and well, and the Fed has to be careful about that.
So are you basically saying, if I'm extrapolating out perhaps a little bit too much, that you think if the Fed goes as aggressively as the market is pricing in, that you run the risk of reigniting inflation as a serious concern, and that actually overheating becomes once again in the forefront of our minds, even now with some of this economic data and those trucking companies reporting some disappointing earnings?
Yeah, it is difficult to see the economy kind of resurge, go higher again, right? To overheat, Lisa, and it's difficult for us to really see inflation start going back up again. But obviously, the Fed is really worried about that. I mean, there's a lot of reasons why inflation could be stickier, right? And you have all this geopolitical risk that seems to be getting worse, not better. And obviously the political situation could spur more economic activity and cause inflation to go higher, given tariffs, et cetera. There are labor shortages around the world. You have, energy problems, this energy transition and climate risk. So there's a lot of reasons to think that inflation could be stickier. And the Fed is really focused on that, right? I mean, personally, it feels like inflation is moving in one direction and it's toward two. So, there's the markets feel pretty balanced here. I mean, the 10-year Treasury, where it is today, feels, fair value to maybe a little bit full, like I said. We would really look for opportunities to add duration if rates back up from here. But the trend, as you said, has been one way so far.
Mike, I'm distracted. I've been down to us for the last 5 minutes. Who gets the trophy? What's it for?
Hopefully me, Jonathan. This is our annual golf tournament, so I'm in third place, looking to take it home.
Good luck. Michael Collins,
Thank you.
PGIM Fixed Income. Thank you, sir. The real stuff. You find out what they're really up to going into the weekend. It's like payrolls, yeah, super serious. Golf tournament, final round.
So how quickly does the tie come off? Sort of pull on.
The golf shoes are on and they're ready to go.
Yeah, exactly.
Like 8:31 Eastern time.
Here down.
Out the door. Mike McKee's ready to go. He's in the studio. Mike, it's good to see you, sir.
Yeah.
Do you think Wall Street's overdoing it here?
Yes and no. I mean, it matters a lot for Wall Street because you're betting on, you're making asset bets on what you think is going to happen. But I think that I've pointed out to you earlier that the Fed isn't saying that they're data point dependent and this will make all their decision for them. And we were talking in the green room a little earlier about how this is going to matter for a few days, but then all of a sudden we're going to start talking about the SEP. What is their forecast for the future? And that's what will matter going into the Fed meeting. So it all kind of just goes by. I also pointed out that more Americans are worried about what Taylor Swift wore last night to the Chiefs game than the jobs report, I'll bet you.
Surveillance is very concerned, though, about the jobs report, and let's focus on that. And I would like to say that we're very focused on the statement of economic projections and how this labor market report fits into that. And that, I think, is the reason why it really matters.
And that jobs report drops next. 5 minutes away. Going into it, equity futures decline on the S&P 500, just a little bit softer, and the bid in bonds begins to fade. Yields are lower by not even a basis point at the front end of the curve. The jobs report up next. Mike McKee breaks it down, reacting. Jeff Rosenberg of BlackRock, Torsten Slok of Apollo from New York. This is Bloomberg. The jobs report, 25 seconds away. The scores look like this. Equity futures on the S&P 500 declining by 0.5%. On the Nasdaq 100 down by 0.8 in the bond market. Let's take a look at the yield curve. 2-year, 10-year, 30-year. Yields just a little bit lower, down a basis point on a 2-year. 372. On a 10-year, down 3. 369.67. The number we're looking for, 165 with the jobs number. Here's Mike McKee.
Well, here we go. Somewhere in between. That's going to make a dilemma for Wall Street. 142,000 jobs, but the unemployment rate does tick back down to 4.2%. Net revisions over the past 2 months down 86,000. So you take 86,000 away. Now we'll have to see what the breakdown of that is, because if you took 86,000 away from last month's very low number, you're not going to get very much. Average hourly earnings up 0.4, much stronger than the 0.2 of the month before of July, even higher than the 0.3 anticipated. And weekly hours rise to 34.3. Now, if you were looking for some sign that the economy was slowing, but we're not yet laying off people, you'd look for jobs to be, for hours to be cut back. And that is not what is happening at the moment. So I'll break down more of this, and John, you'll tell us what the market's thinking.
I was hoping you'd carry on for a little while so I could make sense of it, Mike. So initially off the back of this, the bond market got sold and then it immediately got bought. At the front end of the yield curve, we're down by 8 basis points on a 2-year. As we always say, it's the first move. This is the second move. We'll see if it sticks. On a 10-year, we're down about 5 basis points. It's a break of 370. So that's the bond market picture. In response to that in foreign exchange, dollar yen dropping lower to about 142, so we're negative by 0.6%. Near session lows on that currency pair. The equity market turned positive initially at first look and then dropped back again. On the S&P 500, we're down by 0.5. On the Nasdaq, we're about back to where we were, down by 0.9. At first look at these numbers, Lisa, I have to say, these numbers will not solve the debate in any way, shape or form on Wall Street this morning.
Definitely won't solve the debate. But one aspect of these definitely speaks the loudest to me. And that's, and I'm biased, obviously, because this is what I thought going in, the downward revisions and the fact that last month, which was already negative, was revised lower even to 89,000. To me, that is significant. And that is going to cause the Federal Reserve to have a more difficult decision than, say, if it were 100,000. But still, you are seeing that being priced into markets. This is a Fed that's going to be headed lower on a more aggressive path.
So the bad news is last month was even worse than we thought it was. Mike McKee, the good news is that unemployment's dropped back from 4.3 to 4.2. Is this good or bad?
Yes. It depends on what you're looking at. I think this doesn't make a case one way or another, which would leave you with a default of 25 basis points. Now, job growth is slower. We've got to break that down and figure out exactly what's going on with that. But the unemployment rate falling back tells the Fed that we're not losing a lot of workers and the economy is not falling off a cliff.
What this does show me, though, is that these are messy numbers and that the path has been downward. And that has been the consistent path in terms of revisions. Mike, are revisions getting maybe a bigger look in this particular cycle just because it has been a noisier set of data post-pandemic?
Well, I suppose they're getting a bigger look, but you always get revisions and they follow the trend. When the economy is slowing, revisions tend to be negative. When the economy is growing, they tend to be positive. And we're obviously in a slowing environment, so the revisions are going to be negative. That's not going to surprise anybody at the Federal Reserve. But basically, what they're looking at is how many people have lost their jobs and why. And that's the question that we've been trying to answer now. Remember, last month we saw a huge number of people who had lost temporary jobs or were on temporary layoff, and that number has dropped back tremendously. It was 1,062,000 in July, and now it's 872,000. So we're looking at a change of 190,000 lower, and that does suggest that the July numbers in terms of unemployment were kind of a one-off.
In the commercial break, we were debating with Jeff Rosenberg of BlackRock what would be the most confusing labour market report today for the Federal Reserve and for market participants. And Jeff said something like, if you got a slightly softer jobs report, but unemployment actually dropped back from 4.3 to, say, 4.2. And Jeff, we got a mix. That's the mix we've got. So Jeff Rosenberg of BlackRock, Jeff, please make sense of this for us.
Yeah, tough to make sense of it. It's a bit of that mixture, but I think the headline reaction is to the slightly weaker payroll headline and the revisions, as Lisa was pointing out. So it's a little bit weaker on margin. You know, the bond market is very much behaving as if, if we price it, they will cut. And so increasing the probability or trying to push the probability to 50. I don't think this report is definitive on the 25 versus 50. I think it's going to be Waller.
What do you want from Governor Waller? Jeff, at 11 a.m. Eastern Time. What are you looking for? You think that's the final voice that sets up whether we go 25 or 50?
I think it is. I mean, I think it's set up on the calendar to give markets clarity on what the Fed's going to do. He will have had the information. He would have had a chance to talk to Powell. And so that you don't get a big market reaction, not next Wednesday, but the 18th when the FOMC meets. So I think it is intended to, provide a little bit of a steer to the market. So I think that's going to be, as important as the number that just dropped, what we get in terms of the reaction. And it's hard to say, which way they go. I think the market is pushing for 50. This number isn't, particularly weak. You have the potential of the first print bias lower on the headline. Maybe that gets revised, up. We're talking about revisions. This is a weirdness in the data where August tends to be weaker. There's a slowing and there's an argument, on both sides. If they do 50, does that, kind of signal too much concern? They can talk around that. They can talk about 50 and talk about their confidence in the economy and kind of ease some of that concern. So the market has been kind of right in the middle between the two. This morning, I think it's really just about that revisions and a little bit weaker relative to the expectations and consensus around 165, coming in a little bit below that.
As an investor, what's your response mechanism to a Fed that signals 50 basis points of a rate cut? Is it basically just extrapolating out about 150 basis points of cuts this year, and that essentially that's going to be questionable for risk assets? Or do you say this is supportive because this means that they're going to adjust quickly back to something that the market thinks is more neutral?
Yeah, we had that debate yesterday. I think it's a tough one. Typically, when the Fed cuts 50, they're cutting 50 because there's a growing deceleration in the economic data. This is a tricky period because you obviously have a lot of focus on the labor markets and the labor market deceleration as being the leading indicator. It's not really a leading indicator. It's kind of coincident. Some measures are lagging. The rest of the economy looks strong, but there's this fear that the Fed is behind the curve and that the rest of the slowdown is coming, and the rise in terms of kind of hard landing fears. And so 50 might, kind of push people along that direction. So it's more negative rather than the Fed's kind of on the job. It's, the Fed's behind the curve. The 50 basis points validates our fear. And then you have all the other issues in terms of, risks, high valuations, concentration in terms of valuation in the tech sector, all kind of leading to a lot of angst. And then even what we saw last month, in terms of the outsized market reaction, positioning I'm talking about August 2nd and August 5th. So I think the risk here is that 50 could be more of a negative signal than a reassuring signal that the Fed's on the case. But yeah, it's a tough call either way.
Well, you were having the debate yesterday, Jeff, not just the market more broadly. What would your reaction be given the fact that the Fed doesn't have proprietary data that we don't see that points to a more conclusive signal about where this economy is headed?
Yeah, it's really about the Fed's shift. We saw it from Jackson Hole and Powell, and it's shifted this whole narrative focus and really market reaction focus onto the growth data away from the inflation data. And that shift means the Fed is worried now more about securing the benefits of their past policy intervention to secure the benefits of reducing inflation, and now focusing on securing the soft landing. So all of any signals around their sensitivity, any validation of that in terms of the data, makes people very much on edge that you're back not to the what Powell called the era of flouted rules, that you can't rely on these rules like the SOM rule, like labor market differentials and other things that people point to when you have recession signals, that those may actually in this time be the right signal. And that kind of concern that you see in many commentary, many forecasts, gets more validated under a 50 basis point cut scenario. And I think that's the concern. That would be, the pushback. they can signal around that. They can use the language. They can use the press conference to manage that. But it's a tricky needle to thread.
Hey, Jeff, this was great. Jeff Rosenberg of BlackRock. They can use the speeches through the next few hours. 8:45 Eastern Time, we'll hear from the New York Fed President John Williams. Later on this morning, Governor Waller at 11 a.m. There was a note from Neil Dutter of Renmac before this number dropped. He said, whatever the number is, it's being overestimated. When we talk about the bias in the market, you nailed it, Bramo. You talked about the revisions. That's what Neil's talking about.
This idea that probably you could see even more downward revisions, and something that Mike said, when you have a slowing economy or a slowing labor market, the revisions tend to be to the downside. If that's the case, doesn't this just edify that kind of sense that we're slowing? It sounded like Jeff Rosenberg didn't have a conclusion to the debate in terms of how they're going to respond.
There's no conclusion to this debate.
There is no conclusion, and that's, I think, the issue. People don't know how to deal with this, but you are seeing that sort of jitteriness follow through after this with yields markedly lower.
I can tell you what the bond market is doing, just to pick up on Lisa's comment with yields lower. We're down 9 basis points at the front end. Just moments ago, we took out the August 5th low on the 2-year, which was the low for the year. We dropped to about 363. We're at 364 right now at the front end of the curve. So that's a double-digit basis point move on 2s. On the 10-year, we're down 5 basis points at 367. Equities are curious because once you see that picture, you start to think about the bad news is bad news scenario. Equities are doing okay for now. Equity futures, Lisa, down by 0.2%.
Which is essentially what a lot of people are hoping the Fed can actually navigate, which is a 50 basis point rate cut, which is now being basically priced in this month with that positive view forward that they're just adjusting rates more quickly to a neutral rate, not responding to an emergency situation.
Mike McKee still with us, going through these numbers. Mike, what jumps out for you?
Well, I'm going to front run John Williams and Chris Waller and say that they're going to do 25 based on the underlying numbers here, which are all pretty good from the Fed's point of view. Aggregate weekly hours up 0.3 after falling the prior month. That's used as a sort of proxy to help you figure out GDP. When you look at the unemployment rate, the level change in the labor force was up only 120,000. It was up 420,000 the month before. The number of unemployed went down by 48,000 in the household survey, while the number of employed went up 168,000. And we already mentioned hours worked. They went up. Not only did hours worked go up in general, but manufacturing hours worked went up and overtime hours worked went up. So it does appear that the economy is still fairly strong. And this sort of matches what we saw in the Beige Book. Companies aren't getting rid of workers, but they're not hiring them either. So if you're the Fed, there doesn't seem to be an emergency.
As Torsten Slok of Apollo got two benefits there. One, he got an extra 12 minutes to go over all of this. And two, Mike McKee set him up perfectly because, Torsten, you just sat there nodding. You agree, don't you?
100%. I mean, let's look at the numbers. Non-farm payrolls in August was better than in July. The unemployment rate in August was better than in July. Average hourly earnings higher than in July. And you look at average weekly hours, also better than in July. I mean, this report is better than in July. This economy is not slowing down in the way that markets are anticipating. We will not get 8 cuts over the next 12 months. Here, you should instead look at this report as this is really telling you that there is a soft landing.
So help me with this. In October, when we look back at this report and we get another revision, a downward revision, don't we have to reframe some of this conversation and just say everything keeps getting revised lower? This is Lisa's point over the last few days. This economy, this labour market is weaker than we initially thought it was.
But GDP in the second quarter was 3%. It was just revised up. Jobless claims continues to be good. Continuing claims was also good. If you look at the daily data for how many people go to restaurants, how many people fly in airplanes, the weekly data from Redbook on retail sales, if you look across the board on bankruptcies, if you look across the board on credit card spending, in the aggregate, the growth data is just not showing signs of a slowdown. It is true that the labor market is weakening, and yes, the JOLTS data has been a little bit, maybe more in balance, as the Fed would be saying. But this whole notion that the economy is slowing down rapidly, it is completely misguided.
What I thought was fascinating, I was speaking to a number of retail executives at this conference this week, and their biggest question was, what's going to happen with the consumer? They didn't know. They had zero visibility. Even though you are seeing some trends, some signs of robustness, so some signs of weakness, they said ultimately it just depends on whether they have the money to spend. These labor market reports are raising a red flag for a lot of people, saying if they lose their jobs, they won't. How fragile is that sort of happiness that you're describing to a scenario like that?
Certainly, if we do have a rise in the unemployment rate, so that's not what happened, the unemployment rate went down, it would become a problem. But if you also, exactly as you know too well, look at what they did say, the retailers, during this earnings season. Target said no sign of a slowdown, Walmart, no sign of a slowdown, and also Costco, no sign of a slowdown. You saw Dollar General, some parts of consumers are under more distress, but broadly speaking, looking at retail sales, both the monthly, the weekly, and across the board on credit card data, there is just no sign of a sharp slowdown. So the bottom line in this discussion is that you only get a recession when you have a really big shock to the economy. And that makes sense, of course, with COVID, Lehman Brothers going under, of course, the bust of the IT bubble in 2000. But this is not an exogenous shock with something coming from the outside. This is all engineered by the Fed trying to slow things down. And now the Fed is telling us that they're about to lower rates. So that's about to counter some of those negative things
as
that
you
have
speak,
been weighing on the
we
economy.
get another headline from the Federal Reserve. Mike McKee from the New York Fed President, John Williams.
Yeah, John Williams is saying it is time now to join the party. He is not commenting in his prepared remarks about today's numbers. Of course, he wouldn't have had them ahead of time, but he does say it's time to cut rates. With the economy now in equipoise, which he titled his speech, that means in balance, and inflation on a path to 2%, it is now appropriate to dial down the degree of restrictiveness in the stance of policy by reducing the target range for the federal funds rate. So the guy who's vice chairman of the Open Market Committee is saying we're going to cut rates. He's not yet talking about by how much, but there is a Q&A, so we'll keep an eye on that.
And apparently owns a thesaurus, too, over at the New York Fed. Torsten Slok, what do you make of that, and what are you looking for from Governor Waller?
So I do think Waller will also give some more guidance in terms of what's going on, at least with the bigger economic picture. But I don't think that he will tell us much about whether this is 25 or 50. It requires probably a very important debate, given the spectrum of where FOMC members have been recently in their speeches. Some are clearly saying, some are even suggesting we should have much fewer cuts over the next several quarters. And others, of course, are suggesting that we should go much faster. So I do think that they need to gather in the room and think hard about, do we want to go towards 25 or 50? I would say, and I would agree with Mike, that 25 is the right number, given that literally everything in this report was better than in July.
Would it be a policy error, though, to go by 50?
See, that opens up the debate about our star and how far do we need to go down. If our star and where we need to go to, and ultimately, so real rates plus inflation, if we only need to go to 4.5, we're not far away from that, so there's no rush to lower rates. If we do need to go all the way down to 2.5 or 3, then there is certainly more of a rush. But given the incoming data across the board is still good, why is there this rush to cut rates so dramatically, other than the R-star framework, which says that we got to get going?
Jackson Hole's speech was all about understanding the effect that Fed policy has on the overall economy. The conclusion was we still don't know. We don't have a sense of exactly how quickly it gets sort of transmitted and how much of the lag effects that we're starting to see. There is an argument if you cut rates more aggressively now, you can get ahead of some of the lag effects that we haven't yet even seen. Why don't you give credence to that?
Because there are three very important reasons why we did not get that slowdown that we all anticipated for so long throughout 2023. Remember, they started hiking rates in March of 2022. First of all, consumers and firms had locked in low interest rates. AI investment has been very strong, and fiscal policy has been a huge tailwind. All these things combined have been the key reason why the economy has not slowed down. And those things are actually still in place. A lot of people still, of course, have low interest rates in mortgages, in investment-grade credit, fixed rate, also very locked in for a long time. So that means that if you do start cutting rates, it's actually the transmission is also going to be weaker on the downside. It was weak when you were raising rates. It's also weak when you're cutting rates. So because of that, AI investment still strong, fiscal policy from CHIPS Act, Inflation Reduction Act, and Infrastructure Act still strong. All this argues that the data will just continue to be steady over the next several quarters. There is no reason to expect this to be a hard landing. There is no exogenous shock similar to what we have seen during previous recessions.
Torsten, can we go back to the revision for a second? If you take off the 25,000 we took off last month and you do here for August, you'd get 117. Would you still feel this way if it printed 117?
Sure. Of course, the revisions are very important because we have seen some modest slowdown, but broadly speaking, the data was still better than what it was in July. So taken as the overall picture of, in particular with the unemployment rate, which is especially important when you put that into your Taylor rules and try to figure out what should the reaction function be from the Fed. And that's how all the regional Feds prepare the forecast. And if the unemployment rate goes down, it's hard to argue why they should be going 50. To go 50, you need some very, academic argument about our star, and you got to get going with lowering rates very, very quickly. And the question is, with the incoming data being so strong, is monetary policy really so restrictive? It doesn't look like it's restrictive. If it was really restrictive, the employment report would be a lot weaker.
Pause, because this is exactly where I wanted to finish with you. You're saying 550 is still not that restrictive for this economy?
So if where we're going in the terminal rate is 4.5, is 5.5 far away from 4.5? I know we, have been somewhat, not quite brainwashed, but very distorted by a lot of FOMC members continuously saying we got to normalize rates, normalize rates, normalize rates. But let me ask you this, John. If we really had restrictive monetary policy, why have we for 2.5 years and counting still been getting very good economic data, including GDP in the second quarter at 3%?
The lags are just longer. They might say the lags are just long.
What should be the reason for that? The tailwinds from AI continue to be strong. The tailwinds from fiscal policy is still strong. We have locked in low interest rates for the consumer and for corporates. Where is this very significant transmission of monetary policy?
When we sit here and do this again a year from now, we'll do it before then, don't worry. In 12 months' time, where do you think rates are? They've got a 4 handle? They've still got a 5?
I think that they will be much higher than what the market is pricing at the moment, because this is not a shock that is generating a recession. Why haven't we had a recession for now 36 months and counting? I mean, it is really the case that the economy and the economic data has just been much better than what literally any model would have predicted, for the reasons that I just mentioned, namely locked in low interest rates, tailwinds from fiscal policy, and AI spending being completely independent of whatever the Fed is doing.
This is box office, and we should do it again next week. Torsten Slok,
I'm
thank
ready
you,
next
sir.
month.
Looking forward to it. Torsten Slok of Apollo, thank you very much. So the data's better than expected. If you look at the totality of the economic data in this labour market report, the yields are still lower because this Fed is still going to reduce interest rates. Equity is just starting to inflect a little bit higher. The one thing I'd like to know, if you want tomorrow's prices, I want the close at 4 p.m. I want to know if equities actually close positive on this report.
Because then it's basically saying to the Federal Reserve they can cut by 50 basis points and still signal that it's not because things are falling off a cliff. This from Priya Misra. We will stay stressed out. Now all eyes on the Fed. The faster they normalize, the less they will have to do, and they can keep the soft landing alive. Don't know if they're there yet.
Up next on the programme, we'll set you up for the week ahead. A big week ahead. The debate continues. Nothing's been settled around this table. From New York, this is Bloomberg. Everyone needs the weekend. Counting you down to the opening bell. 36 minutes away. The calendar looks like this. Today, Fed speak, Governor Waller, 11 a.m. Eastern Time. Ahead of the blackout period. This is really important stuff before the Fed goes quiet. Monday, new iPhone from Apple. Tuesday, Vice President Kamala Harris and former President Donald Trump facing off in their first debate. Wednesday, the Fed's next big data point, US CPI. On Thursday, we'll get PPI plus another round of jobless claims and an ECB rate decision. And on Friday, Mitch, consumer sentiment. A final word around the table. Bramo, first to you.
Does CPI matter at a time where the focus is so squarely focused right now on weakening in the labor market? To me, that's my real question, and whether the Fed really leans into 50 basis points.
Particularly after wages came in just a little bit hotter than expected. AMH?
Bank of America saying after the most important NFP number, we have next week's U.S. presidential debate, next market catalyst. Will it really be a market catalyst? Do we actually get details from either of these candidates?
The last payrolls report going into that debate. Coming up on Monday, this is the lineup for you. Joe Quinlan of Merrill Bank of America Private Bank, Ed Yardeni of Yardeni Research, Sonal Desire Franklin Templeton, Jim Bianco of Bianco Research. We said repeatedly it's a pivotal jobs report. It's decisive. It's settled absolutely nothing on Wall Street. The debate rages on.
And right now, this was not decisive for 25 or 50. It was not decisive for a neutral rate. To me, that will be an ongoing discussion. But right now, you see a labor economy that is downwardly weakening and that continues to do so. And to me, that needs to be really focused in terms of the balance of risks and how the Fed responds to it.
Those revisions appear to be a trend, which is why the New York Fed President John Williams has already come out this morning and said now is the time to reduce interest rates. Equity markets just about unchanged. The bond market is rallying. Yields are lower by 5 basis points. The 2-year is at 369. The 10-year is at 371. We have a normalizing yield curve. We'll leave that going into the weekend. From New York City, thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.